It's been a spectacular earnings season so far.
The equity market is being driven by corporate earnings.
You've still got a little bit of upside.
We're still maximum overweight in equities.
Short term, it's a bit more consolidation. We like the market longer term.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday with oil inching lower, the diplomatic push happy to drive crude below triple digits. As powerful earnings are sending stocks to fresh record highs, the data is keeping Federal Reserve officials firmly on the sidelines. More data coming up later.
Look, this is a solid market. Yesterday we got the ADP print, came in at the hottest level, the greatest number of jobs going back to January of 2025. At 8:30 a.m. Eastern, we get jobless claims. Does it give that same read? Do we get another record low in terms of people who are filing to get benefits for not having a job? Or do we see some tick up? And this all, of course, comes ahead of tomorrow's payrolls report. What do we do with it? If it's really strong, is that going to be a good thing? Is that going to be a bad thing? Most people seem to say that will just keep this equity market ripping.
I think it's really impressive the Fed's just about holding on to an easing bias. Other central banks are hiking. Saw it in Australia earlier this week. Saw it in Norway earlier on this morning. Europe seems to be heading in the same direction, maybe as soon as June. And in America, we've got better economic data, really powerful earnings, and we're holding on to an easing bias at the Federal Reserve.
This is part of the reason why the dollar is underperformed. This is part of the reason why people have said, ultimately, how much is this a political decision versus something that is rooted in fundamentals? Do we still have the disinflationary tailwinds that so many people were talking about? Norway hiked interest rates. It was a surprise. Very few people expected it, in part because they saw wage price inflation. That was a key aspect of that. If you start seeing that in the United States, well, that might force the Fed's hand.
Brent crude this morning, 99. WTI, front end of the futures curve around 93. This from the Journal. President Trump's advisors increasingly worried that Republicans will pay a political price for spiking fuel costs. Will that grease the wheels of the diplomatic effort in the weeks to come?
Absolutely. And that's what we've been talking about for weeks on this program. Why do you think the president had Mike Wirth of Chevron and all the oil traders over at the White House to discuss how acute is the situation going to be the next few months ahead of the midterm elections? And it is likely why he is rushing to try to get the Iranians to agree to this one-page memorandum when it comes to the peace plan, because he needs the Strait of Hormuz open. He needs the oil to continue. The fact of the matter is, though, as we wait for the Iranians to respond, the Strait of Hormuz is forever changed, and the Iranians have complete control over it now.
You showed me a note from RBC earlier on this morning. Have we actually made progress here, or is this just a ceasefire rebrand? The words of RBC overnight.
It's a way of saying, essentially, the war is over, but we haven't really changed we haven't moved the needle, we haven't moved the dial. And guess what? What Helima Croft is talking about is barrels are not moving through the Strait of Hormuz. We still haven't addressed what will ultimately be a shortage as soon as July.
As the economic fallout spreads from Asia westward, it will likely become more difficult for positive Axios headlines to paper over the unprecedented physical outage. Helima Croft. And you know what? I saw a tweet yesterday that was like, you know what? If we just had Axios in 2007, maybe we wouldn't have had a housing crisis.
Could have avoided the whole thing. Axios is getting some real mud slung at them, hey. For the record, I like Axios.
So do I.
And I like the work going on there.
There is underpinning that skepticism about the placement and timing of some of these missives. And I think that goes to, and I'm not going to talk about Axios because, frankly, I'm glad that there's reporting out there.
It's the market's fault.
Ultimately, this is a market that feels subject to all of the manipulation of different officials from different sides of the world who are trying to come in and jawbone them. And people are getting sick of it. So that is the frustration being channeled at one Axios reporter.
We can spend 30 to 45 seconds more on this, so bear with us. Whenever I see reports like this, I've always looked at them the same way. That is an effort to signal from whoever is behind the messaging. That is an effort to signal. And that's always how I've read between the lines. I don't look at the reporting and say, oh, this must happen now because so-and-so said this. I look at it as saying, you know what, someone in the administration wants to signal that this is where things are heading. Why might they do that? And then give it thought from that kind of perspective.
And the difficult aspect here, you're absolutely right. And for the most part, the market treats it as such. At the same time, this isn't President Trump's to signal alone. And that's part of the problem, because ultimately this is a quagmire where you've got to get ships going through there. It's one thing to say it's open. It's another thing to convince a ship operator that they're not going to get shot at as they go through the Strait of Hormuz.
Brent at 99, WTI at around 93. Coming up this hour, we'll catch up with Darius of 42 Macro, with stocks on a record-breaking rally. Eswar Prasad of Cornell as trade tensions rise between the US and Europe, and Earl Daves of BMO on why the Fed could end up hiking interest rates next year. We begin this hour with stocks holding at record highs as optimism grows over an end to the war. Darius down at 42 macro, writing the 12-month outlook is bullish. The next few months, however, may prove volatile. Darius joins us now for more. Darius, good morning. Good to see you.
Oh, great to see you, John. Thanks
Hey, welcome to the program as well. What's going to be the source of that volatility?
Well, I think we're not out of the woods yet as it relates to the Strait of Hormuz dynamic. And we also have the return of crowded bullish positioning across global financial markets. So if we get another Axios headline that, is leaking in the wrong direction, then you can have a little bit more volatility. But when you take a medium-term view on the markets and on the economy, things are about as good as they've been in a really long time, I'd say since early 2021.
Let's just stay on that. Look at the economic data. Look at the earnings. How impressive is it that we've got a central bank that's still holding on to an easing bias?
Well, that's a totally separate conversation. But the thing I'd say about the Fed is the biggest mistake the Fed can make this year is doing anything. This is an economy that has accelerating inflation. When you look at the inflation components that they care about, this is an economy that has accelerating bank credit growth. At the same time, we have a productivity boom, and in our view, we think we're heading into a jobless recovery. So on the push-pull dynamic there should say the Fed should stay on hold. I think the markets would probably not like the Fed doing anything in any one direction because it would create tension on the other side of the mandate.
It's not totally unrelated, though. The whole point is when you have such robust growth, to John's point, the strongest, as you were saying, since 2021, and then you have a Fed with an easing bias, how much does that increase the risk of an inflationary kind of impulse that it creates a headwind that people aren't really pricing in?
Yeah, well, I think we're already seeing the inflationary impulse. If you look at, for instance, core PCE inflation on a 3-month annualized basis, we're at 4.4%. Supercore PC inflation, we're at 4.5%. So we already have the inflationary impulse. And so the best thing the Fed can do right now is to jawbone that away to the extent possible. In our view, we think it's going to go away because if you look at the relationship between productivity growth, we think we're in a 150 to 200 basis point acceleration in trend productivity growth. That should knock off about 40 to 50 basis points from trend inflation, while at the same time you have some very depressing components in the labor market that are weighing on wage inflation from a cyclical and structural standpoint. The real inflation dynamic in the economy, when we get past this inflation shock, should be much lower, in our opinion.
You said that there was this depressive factor coming from the labor market. How would this market treat a very hot labor market report tomorrow? Let's say the number of jobs created much above what people had expected. Let's say wage increases much more than people expected.
Yeah, I think what's going to happen is the market's going to price in more tightening in the short rates curve. And so that's, in my opinion, I think that would be an appropriate response from the market. But the reality is we don't think that dynamic is sustainable. When you look at, for instance, core private services payrolls, which lops off healthcare, social services, education, and government, basically everything that the government is the main consumer or the employer of, that peaked 2 years ago. 2 years ago. And so in our view, we think this AI dynamic is real. I mean, it's hard to statistically test it, but we think it's real. We think we've never seen a trend like this with the booming economy.
You think when it comes to AI that actually it's going to help international stocks over U.S. stocks?
Yeah, I think it's going to help all the stocks that have been left behind by the mega cap tech companies. And the reason we say that is not because we're bearish on the mega cap tech companies, is that we think that the transfer of that technology will create a convergence in productivity, create a convergence in margins, create a convergence in ultimately in valuations with the stocks that have been left behind from a capital allocation standpoint.
When will we see that?
I think it's already ongoing. I mean, the trade started a year and a half ago. So I think that trade, we obviously took a pause in the context of this, Strait of Hormuz dynamic because that's a cyclical headwind in the economy. Once we open the Strait of Hormuz and those barrels of petroleum products are flowing, I think the market's going to start to look around and say, hey, we have a lot of crowded bullish positioning here. We don't have any crowded bullish positioning here, but we're going to see a convergence in the operating metrics.
Just sit on that just for a moment. The biggest risk to the tech rally might be a reopening of the Strait.
Yeah, well, on a relative basis. I don't think you're going to sell tech stocks on that, but I think on a relative basis, yeah. Can
we just finish on the capex boom from big tech? Do you think that is a bubble? How do you think about the capex intentions from a handful of companies?
Well, look, I'm not smart enough to determine if it is or is not a bubble, but I will say much better investors than I have said when something doubles in 3 years, and we're obviously seeing a double in AI capex in 1 year, it's a bubble. And so the key takeaway is that whenever you have these historical capex bubbles, you go back to the railroad bubble, the consumer durable goods bubble, and the IT capex bubble, they tend to end in secular bear markets. So I think that's where we're headed longer term, but I don't think that's a medium term risk.
What do you do with chips in the meantime? Seems to be a question I get a lot. We've seen this massive rally. Something that stuck out for me this week was a comment from Barclays. We caught up with Mr. Altman over there, and he said, we need to focus on where we are, not how we got here. How we got here was super fast, vicious rally. Where are we now? The valuation, what is the price we're paying up for some of these chip stories?
Yeah, it's a Looney Tunes price, but again, twice as silly price is not twice as silly, right? I think that our friend David Einhorn said that a while back in the meeting. So the thing I'd just say on the chip stocks is that you have to take profits and start to look at businesses that are going to have a faster convergence in their profitability. These are lower comparative-based businesses from the perspective of margins, from the perspective of earnings. So you transfer that technology, we're going to have a faster rate of change in their growth rates. And in our opinion, that's a durable catalyst.
So just pick them out. What sectors are you focused on right now?
I mean, financials are the obvious component.
The banks.
The banks, yeah, the banks. I mean, there's so much more. I mean, it's very dark, but the banks have a lot of, employee compensation as a percentage of their total revenue.
You're expecting job cuts?
It's the underperforming banks will cut jobs, underperforming companies will cut jobs, but the best performing companies will just stop hiring. And we've seen that in the labor market, a little higher, a little fire.
Attrition. Darius, it's good to see you. Thank you, sir.
Great to see you
Thank you very much.
For
Thanks for being here. Darius Dale there, 42 Macro. Not a great start to the morning if you're at a bank listening to this program.
This has been an ongoing fear, and we've actually seen the industry shrink. If you take a look, the number of jobs have been contracting over some time. But right now, that to me is the key question, how quickly this goes.
Let's give an update on stories elsewhere this morning with your Bloomberg brief. Yahara Anand has more. Hey, Yahara.
Hi, John. The U.S. is waiting on Iran to respond to its proposal to end the war. The Trump administration presenting a one-page memorandum of understanding to Iran that would reopen the Strait of Hormuz and lift the American blockade on Iranian ports. Negotiations over Iran's nuclear program will come at a later date. Israel carrying out an attack in the suburbs of Beirut. Prime Minister Benjamin Netanyahu saying Israeli forces were targeting one of Hezbollah's senior military commanders. Tehran has threatened to withdraw from the ceasefire if Israel keeps up its attacks in Lebanon. And the EU failing to finalize a trade deal with the U.S. during overnight talks. President Trump threatening to increase duties on EU cars and trucks if the bloc does not make substantial progress on a deal. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next on the program, declaring victory once again.
They want to make a deal badly, and we'll see if we get there. Their leaders are all dead, so I think we won. Iran cannot have a nuclear weapon, and they won't. And they've agreed to that.
Up next, we'll catch up with Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. More data coming up later this morning, 8:30 Eastern Time. Jobless claims in America at multi-decade lows. Look out for that. The labour market data has been okay heading into payrolls tomorrow morning. Then we get some more Fed speak. Mary Daly of San Francisco coming up a little bit later. We'll join her on Bloomberg TV with Michael McKee, so looking forward to that conversation. From what we've heard so far from Chicago, from St. Louis, the regional Fed presidents, these guys are not in a rush to cut interest rates.
They're concerned about inflation, and a lot of the people in markets are seeing what they're seeing and agree with them. I mean, the idea that you just pointed out that the Norwegian central bank just hiked rates, which was a huge surprise to economists, show just where the balance is overseas. In the United States, if you get a hot labor market print, how much more difficult does it make it for the Fed to retain that easing bias?
It's amazing we even have one. I think it's amazing we even have one.
They're struggling with it right now. That's clear,
right.
And that was clear from the dissents.
You go through the communication from Norway, and they're worried about inflation being above target for the last 4 years. Try 5, right? And an easing bias at the Federal Reserve.
Well, and you have inflation moving in the wrong direction. So the rate of change is not on our side, and that is giving some people some pause in markets. At the same time, you're not seeing break-even rates surge higher. They're creeping higher. At what point does it become a concern for the Fed?
Futures this morning just about unchanged, coming into Thursday morning at all-time highs, driven by some really powerful earnings. It's not just AMD. As Lisa pointed out yesterday, the Walt Disney Company, Uber, just speaks to a consumer that's hanging in there and still spending. Will this help? This move in crude? Below triple digits this morning on Brent, down to 99, down by 2%. WTI, a break of 93, down by 2%. Also, sneak peek of the 80s in yesterday's session, big move lower. At one point, much lower than where we are right now. Under surveillance this morning, declaring victory once again.
No, they want to make a deal badly. And we'll see if we get there. If we get there, they can't have nuclear weapons. It's very simple. But what's not to submit? Their leaders are all dead, so I think we won. Iran cannot have a nuclear weapon, and they won't. And they've agreed to that, among other things.
So here's the latest this morning. The US awaiting Iran's response to the latest proposal to end the war and reopen the Strait of Hormuz. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John. Good morning. Well, a person familiar with the matter tells us that Iran is expected to respond via Pakistani mediators within potentially the next day, as President Trump maintains that a deal will get done. If agreed to, this one-page memorandum of understanding would look to gradually reopen the Strait of Hormuz, with the U.S. lifting its naval blockade, which at this point is still very much in place. In fact, just yesterday, CENTCOM confirmed that the U.S. military had disabled another Iranian-flagged oil tanker that was trying to transit through the Gulf of Oman. Our reporting also indicates that there are active discussions about a potential moratorium on Iran's uranium enrichment capabilities, though at least publicly, Iranian officials have maintained that there will be no concessions related to its nuclear program. And that distance between the two sides is proving problematic, we know, for a longer-term deal, though the U.S. has floated sanctions relief as part of any potential agreement. And new this morning, Bloomberg News is now reporting that China's financial regulator has advised its banks to temporarily suspend new loans to refiners that have been recently sanctioned by the U.S. over ties to Iranian oil, in apparent reversal from guidance that had just been issued last week. But, John, as you well know, President Trump is, of course, facing pressure when it comes to domestic policy, but also when it comes to foreign policy in terms of our interactions with other countries around the world. And he gets ready to move to visit Beijing just next week on May 14th.
Tyler, thank you. Tyler Kendall down in Washington, D.C. On the illusion of progress. You escalate one week, you de-escalate the next week. Ultimately, you make no progress at all, but it looks like you've made progress heading into talks.
So this is where the market seems to be, and this is where Halima Croft comes into play, and this is where some of the people who are watching the molecules not transport and suddenly get worked down in the inventories. They're getting worried. And at what point do you start to see the shortages come to pass? There is a time frame here. You can't do this forever, and I think that's the big takeaway.
It's feeling like forever at the moment, isn't it?
I mean, this is such a exhausting, frustrating news cycle. It's on, off, on, off. What are we doing here?
We're in month 3. I'm kind of losing track of things. Whatever this is.
Like really the never-ending week.
Joining us now to discuss, Colonel Wayne Sonders, Senior Defence Research Analyst at Bloomberg Intelligence. Colonel, welcome to the programme. If we do open up a period of talks, 30 days, whatever it might be, how difficult and how much work goes into negotiating the nuclear program in Iran?
I think that you have a lot of issues between inspections that you have to figure out, removal and transfer of nuclear dust material, the yellow cake, if you will. There are quite a few pieces that require a lot of on-the-ground determinations, right? You can't do it from where we're doing it right now, right? So the inspections piece do have to open back up. What that transfer actually looks like, what infrastructure is left. There's quite a few pieces of that go into play just on the nuclear side. And then obviously the piece that's also going to still be tied to that is still going to be missile related in terms of a delivery mechanism for any type of progress as well, because I know that's big on President Trump's agenda.
Can the United States end the blockade before they make headway on any of these important issues, which are their red lines?
You know, they could, but the problem is it's probably one of the biggest levers right now because, as you've seen, from an existential threat perspective, the attacks aren't really the big threat from the U.S. anymore. We've taken out the infrastructure and the military pieces, which were a remaining piece of the military objective side of the house. They've done that, and obviously there are still more military targets they could if they needed to. But in terms of trying to create a center of gravity analysis and trying to look at where you can apply the most pressure and leverage, it's still going with the blockade. So I think that's one of the biggest chips to say, hey, look, we'll let this up as soon as you guys sign this memorandum. We've got a 30-day negotiation window that would help at least provide some additional formality in there.
So when it comes to potentially this deal, the United States would get what immediately? Just the Strait of Hormuz being open?
Yeah, gradually reopening of the Strait of Hormuz, right? Additional guarantees from Iran that there aren't going to be ties in there. They're going to also have to then look at some type of phased agreement for the easing of the U.S. sanctions, I think. So it's, when I say immediate, it's going to be starting to put that pen to paper in terms of what that deal specifically looks for. The Iranian moratorium on uranium enrichment, I think, is very easy to start. It's much more difficult to actually come in and put it into play. But then also the immediate ceasefire and de-escalation measures are something that immediately have to start. That goes with the IRGC fast boat attacks in the area, as well as anything that the U.S. may do in response.
Colonel Sonders, do we have a sense of what the UAE and Saudi Arabia and Qatar's involvement in all of these discussions are?
I don't have what their part for discussions is, but I do know that they are part of the 50-country coalition, if you will, that France and the UK are spearheading to try and figure out ways to passage and open this up, right? They had their summit back in April. UAE was a part of that as one of the non-European countries, along with New Zealand, Australia, Japan, and South Korea. So you are looking for, I joke around and I call it the Strait of Hormuz Operational Coalition, the shock states. But if they were to actually be able to do that, this is the first time we actually see France taking the Charles de Gaulle aircraft carrier and their carrier set with a couple of frigates as well as escort ships from Italy and Netherlands actually starting to make their way down to the Red Sea and to the Gulf of Aden, which may actually signal that some of the stuff that they planned out in April may be actually starting to move.
Colonel Sonders, how much is this kind of international coalition going to achieve the ultimate goal of reopening it? And I'm talking about those 50 countries as well as, say, Chinese influence that could emerge after the summit between Xi Jinping and President Trump?
Well, I think the biggest thing is this coalition is very much defensive in nature. I think it's one of the biggest reasons why you saw it change from military Operation Epic Fury into Defensive Project Freedom. They changed the name for a reason. It's to start that de-escalation process. It's to start trying to actually, it gives President Trump some off-ramps too, in terms of, hey, I'm opening it up, right? You heard Secretary Hegseth as well talk about that, where he is looking for additional help from allies in that region to, once again, keep it defensive in nature. It's an escort mission. It is not meant to be any type of military operation when you enter in these coalitions. So it's allowed to say, hey, look, we've done our military portion. The offense is done. The defense is in place right now with the blockade. And if you use an football analogy, you've got your offense, your defense, now your special teams. The special teams is really looking at what is that long-term solution with this coalition.
Well, when do you think it's going to restart in terms of Project Freedom? Because the president put it on pause.
Yeah, I put it on pause on Tuesday, and I think it's really coming down probably the next 24 hours for this memorandum deal. I know he's still threatening strikes. I don't think the strikes piece really plays a part, but I do think that the blockade would stay in place, and that part could potentially open back up. I don't think the U.S. wins anything by jumping back into a kinetic engagement at this time.
Colonel, it's good to see you. Thank you, sir. Certainly no one wants to resume hostilities. Colonel Wayne Sanders there of Bloomberg Intelligence on the situation in the Middle East. Now, I'll give you a choice. We can talk about this or we can talk about a virus on a ship. Because I'm committed to not covering the virus on the ship at the moment.
You know...
Fully committed.
OK, but you are... OK, so clearly we're about to cover the virus on the ship. And I will just note, last night, the discussion at home did shift from the war in Iran to hantavirus.
Oh, that's what came up at home. OK.
Mom, how scared should we be? Are we going to enter another pandemic? I had to sit there and we looked at the actual transmission mechanism of hantavirus. And then my oldest son said, why does it always happen on cruises? And I said, go talk to Jonathan Ferro.
That's why I don't go on cruises. It's a long list of reasons why I don't go on cruises.
Hantavirus is among them.
The doomers over at Casa Bramo have changed focus. Have you noticed that? They've moved on. They've moved on quickly.
To AI and to viruses, I'm still on the straight, but yeah.
Are you committed to not covering the story too?
I'm committed.
Committed. I've seen
a
lot of that kind of coverage.
I refuse to go back there. I'm muting tweets. I just don't want to see it. I refuse to believe.
I do think, though, there is a linkage here. Bear with me. Okay. But this was actually at home, the discussion that I directed, which
You've got some time. Go for it.
It's ultimately, people are worried about the next supply shock. Is it going to come from another pandemic? Is it going to come from, you're trying not to laugh.
We're already in a supply shock.
Exactly.
The biggest
so it's sort of this idea of could we
enter
another kind of shutdown, which is what the kids are scared of. They don't want to enter another lockdown because it was really traumatizing.
Have you taught them about dollar cost averaging? Just encourage them to sort of allocate capital into the market on a regular basis.
Yes,
stocks
actually,
are all-time highs.
We've actually discussed this and this question of business cycles.
Don't fear stocks in the markets.
Well, yeah, this was all part of the discussion.
OK, good. Good, we're making some progress.
Good luck with the AP macro test.
Best of luck. Is that today? Best of luck.
AP was brutal.
But they were focused on something else, clearly. OK. I know who we're talking about, and I know they're going to excel anyway, so...
Maybe.
Got no worries there whatsoever. Up next, Eswar Prasad of Cornell, as the EU fails to agree to US trade terms. This from Julian Emmanuel over at Evercore just moments ago. Seeing scope for further tech-led upside on the S&P 500 to 7750 and as high as 9,000. His words, should the public's animal spirits truly move into higher gear.
He's not wrong, and this is what we're hearing from other people. And what would cause the public to move into high gear? What if the Fed cut rates in the face of an otherwise strong economy with the tech investment going gangbusters? Could that be enough to unleash those animal spirits?
There we go. Bramo's bullish.
Well, not bullish, because actually...
Just about.
Then
it's a bubble, then it's a bust.
Yeah,
Got
exactly.
it.
So
Okay.
it just accelerates.
All right, place them up to speed. Equity futures right now in the S&P 500 positive by 1/10%, all-time highs. On the Nasdaq, just about unchanged. In the commodity market, 3 days of losses for crude. We're down by another 2% this morning. 98 handle on Brent, 92 on WTI. We've seen a big drop-off in the last 24 hours.
Absolutely. It's pretty surprising that both Brent and WTI are below $100 a barrel. This is where the administration wanted to keep WTI because they want to try to keep a lid on, of course, what's going on in gasoline. Even if the Strait of Hormuz, though, is open, say Iran, in the next 24 hours decides, yes, we're going to accept this memorandum, we're going to start opening up the Strait of Hormuz, it is going to take weeks and months for flows to start acting as they were previously.
For now, though, good news for the bond market, that's for sure, because at one point in the last week, 10s, new highs for the year on a closing basis, 30s north of 5%. We're not far away, but we're pulling back. That's notable. We're down 2 basis points at the front end of the curve. 2's at about 3.85.
People are pricing out any kind of chance of a rate hike, despite the fact that you're seeing that type of response function from central banks in Norway and in Australia. Key question here, is there enough strength in the underlying economy to keep yields at this level or even potentially higher, even if there is some sort of resolution to the Strait of Hormuz, the situation there? That is where the data that comes into play. That is where jobless claims come into play today. And tomorrow, the non-farm payrolls report, if it is hotter than expected, what does this market do with it?
It's not the base case, but it's a risk. And I think that's why you've got the front end of the yield curve on 2s, yields trading slightly above where Fed funds are right now. That just shows the market pricing in just a little bit of risk.
Yeah, you can see that just heading into next year and about mid-year next year, 2027. People are starting to marginally price in the idea of a rate hike. And actually, at the end of this year, or at the end of next year, you could end up with yields slightly higher. Again, people have no clue. Trying to game this out is like a game of whack-a-mole, especially given that we don't have a sense of what the guiding light will be for the next Fed chair.
We'll play that game in 10 minutes' time.
It's going to be fun.
BMO's Earl Davis joins the programme to play whack-a-mole on the bond market and why we might hike interest rates next year. Look out for that in just a moment. As we count you down to the open about 3 hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the chip designer ARM. Shares are falling 6.8% after it warned of weakness in the smartphone market. This is still a key source of revenue for ARM, even as it sees more money coming in from the hyperscalers. Executives saying that the memory crunch is hitting the lower end of the market, something we heard from Qualcomm, as this memory squeeze quickly becomes the defining theme of this earnings season for the chip makers. Meanwhile, quite the warning from the appliance maker Whirlpool. Shares are plunging 16.5% in the pre-market after the company said the war in Iran is causing a recession-level downturn for the industry. So it's cut its profit outlook for the year, suspended its dividend, and said that price hikes are coming for its refrigerators and its washing machines. And another company warning that the Iran war is hitting its business is Snap. Shares are falling nearly 10% in the pre-market after it warned that the war is hitting its advertising business. But investors might be more focused on this. Snap saying that it has ended its AI partnership with Perplexity, raising fresh questions around its AI strategy moving forward. John.
Yahara, thank you. Didn't see it at Meta. Didn't see it at Alphabet. Becoming convenient, isn't it?
I mean, I'm sorry. When I hear of Snap, of all companies, I don't think supply chain disruption or some sort of Middle East influence. But, to each his own.
Holding back ad revenue. It's just hard to see it elsewhere right now.
It's just such a trendy thing. It's either like Snap, but the kids, they move quick.
Foreign exchange, the weather.
Yeah.
Right, there's always something every quarter.
Yeah, it's true, but people aren't snapping as much.
Oh, is that what's happening?
Yeah, they're moving to other venues.
We're just getting a real-time update on Kaz Abramo every single segment now.
No,
they're not snapping. They're pulled back on that.
That's literally the audience, right?
Okay.
It's people who wanted things to disappear because they didn't want the parents to find them.
Got it.
Or politicians, but we'll leave that one there.
I'm pleased with gauging what's going on here. Thank you, Bramo. What does Kaz Abramo think about interest rates? We'll find out in the next segment. Stay tuned.
There's some heated opinions.
I bet there is. On our radar this morning, President Donald Trump declaring victory once again in the war with Iran, signaling a deal could be finalized in a week. The president also claiming Tehran has agreed that it cannot have a nuclear weapon. Elsewhere, China advising banks to temporarily suspend new loans to 5 U.S. sanctioned refiners over ties to Iranian crude. Washington warning banks of secondary sanctions if they support Chinese private refiners buying oil from Tehran. And finally, the EU failing to finalize a U.S. trade deal in overnight talks. The Trump administration threatening fresh tariffs.
The EU has had a lot of time, many, many months, to comply with their tariff commitments and their commitments on non-tariff barriers, and that hasn't materialized yet. We have to have hard conversations with the Europeans. I'm not setting a hard date on this. My view is it's already past due, frankly.
The White House set to increase levies on EU autos to 25% if a deal isn't reached soon.
I have no idea what's going on between Europe and the U.S. right now. They're just going back and forth, and it seems like tensions are rising, but they're speaking past each other, at least in rhetoric that we're seeing. Europe saying we still have time to discuss this. The U.S. saying, are you kidding me? And that pressure kind of building with the real issue of where does this alliance go, both economically and, frankly, militarily, as we hear about things going on with NATO.
Brussels is trying to add amendments to this. It has been working through a process. For the president, it's been way too slow. The U.S. partially has implemented their part of the deal. The Europeans have not. So I believe that this truth came in basically an essence of just a stick. Please, we need to nudge you along, start implementing it. It shouldn't take too long. What's interesting, though, is Jamieson Greer yesterday, the USTR ambassador, would not put a date on it. So it does obviously seem like they want to keep the window open and they just want to nudge them along. But I was talking to Jenny Leonard, great reporter in Frankfurt, and she says, how much does that have to do just with Germany? Because it was autos that the president threatened. That's to Germany. Of course, we just removed troops from Germany. This all comes after Friedrich Merz said that the president is being humiliated when it comes to the war in Iran.
There's been tension with Germany, not just in the president's second term, but in the president's first term as well. This has been building and building and building.
And at what point does Europe come to some sort of resolution around the animosity with one country? It just goes to the point. Europe is bifurcated or trifected. It's a fractured continent right now. How do they come to some sort of agreement as a unity with the United States? That has been the perennial issue, and it's increasingly in focus right now.
Enter Maloney, who's meeting with Secretary Rubio, I believe, today.
Right, because he's going over there to see the Pope.
The Italians seem to have a role here just to bring down the temperature just a bit.
Yes, to bring down the temperature potentially. I mean, it's the age-old question. When you call Europe, who are you calling? Who's picking up the phone?
Who do you want to call? Maloney at the moment seems to be the more exciting person to call over in Europe.
For this White House?
If you're American, yes.
For this White House, certainly it is Giorgia Meloni. I would say for the Biden administration, it was Ursula von der Leyen. But this is the problem to the really fractured environment in Europe.
Bottom of the list is the Spanish, for a range of reasons.
For both parties.
Yes, without a doubt. Joining us now to discuss not that, but the broader trade arrangement at the moment is Eswar Prasad, the Professor of Trade Policy and Economics at Cornell University and Senior Fellow at the Brookings Institution. Professor, it's good to see you, sir. What is it about this backdrop, the world that we live in, that makes us so prone to supply shock after supply shock after supply shock?
As I pointed out in my recent book, The Doom Loop, we are stuck in this situation where there are no clear balancing forces, where typically one would think about economics like trade relationships as a positive-sum game that offsets all the disruptions in geopolitics. But now, rather than offsetting each other, they are feeding off each other. And the U.S.-European relationship is a perfect example of this. I mean, these are long-standing allies. They have a very strong economic relationship, but now the dynamics are working in a very negative direction. And Europe in particular is in a very vulnerable position right now. They are very dependent on energy imports, and they're also very dependent on exports, especially if you think about the core European economies like Germany. They rely on exports a great deal for their growth. So the U.S. sees a point of vulnerability here. And normally you would think that, again, these are allies who would come together in terms of dealing with issues like the Iran war. But there's been a separation, even in terms of the geopolitical relationship. Europe doesn't quite see the need for the war quite the way the U.S. does. And that has led to a fracturing of both the economic and geopolitical relationship. So I think these are really feeding off each other in a very negative way, even among the closest of allies.
Our mutual friend Mohammed Al-Erin used to talk about the fence sitters. I remember a piece he published years ago. Europe, for me, has been a fence sitter, that it wants the security umbrella of the Americans, it wants the economic exposure to the Chinese economy, and now it might have to make a decision. How hard is it to make that choice?
It's going to be very difficult. As you were pointing out, Lisa, Germany is very dependent on exports, auto exports in particular. And the concern right now for the core European economies, which are really hurting even more than the periphery economies like Spain, is that they are very exposed to US tariffs on the one side and to Chinese exports on the other side. China is running the board when it comes to manufacturing, from very low-wage, low-tech manufacturing to very high-tech manufacturing for cars, industrial equipment, and so on, items where Germany used to have a very strong competitive advantage. And what happens in Germany, of course, matters a great deal for the Eurozone. But there is, as you pointed out, a bifurcation or fragmentation of interests among the main European countries. Germany in particular, and some of the other core economies like France and Europe see things one way, but the periphery economies see things quite the other way. So for Germany, it's very important to maintain external competitiveness both within the Eurozone and outside the Eurozone. But they are facing pretty significant problems in terms of domestic labor markets, in terms of the fiscal problem, while the periphery economies seem to be doing a lot better. So for the periphery economies at the moment, there is some advantage to maintaining a more cordial relationship with the US. But for Germany, the tariffs can really hurt. And the White House is really going for the jugular here. I think you were pointing out the auto tariffs are really going to hurt Germany at a time when they are very vulnerable to Chinese exports. But the question is whether Europe understands that it still has some pretty strong cards to play, but they need to come together. And this has been the problem for Europe, again, the lack of political and economic cohesion. Unless they get their act together in terms of their projecting their power on the world stage, in terms of increasing the euro's dominance in international finance, we're not going anywhere.
The way you describe it, it sounds like a mess. The way that everybody describes it, it seems like things are going from bad to worse when it comes to the prospects for the European continent. And yet the euro is significantly stronger today than it was a year ago. Why haven't you seen this transmitted? I'm talking about the euro versus the dollar. Why haven't you seen this transmitted through the currency the way so many people would predict?
Yeah, that's a great question. Now we are in a world where there are two factors that drive currency values. One is related to macroeconomic fundamentals, what happens to economic growth, what happens to interest rates, and so on. And the second is fear. Countries around the world looking for a safe place to put their money. This is true for private investors, central banks as well. And as you may have heard, there is a great deal of desire to diversify away from the dollar. And if you're trying to diversify away from the dollar, the euro is one potential contender. Now, the reality is that the Eurozone has a lot of weaknesses, and the euro has not lived up to its original promise when the euro was created in 1999. There was a hope that it might actually rival the dollar. For a few years, it looked like it might move in that direction, but it's faded away. But I think this desire for diversification is leading to some safe haven inflows into the euro. And also there is the issue about interest rate configurations. I mean, you've had a discussion about what might happen to interest rates in the US, but there is the prospect that no matter the underlying strength of the economy, the political pressures might lead our next Fed chair to at least prioritize, or at least shift the balance somewhat towards a rate cut rather than a rate hike. And that very prospect, I think, can lead to interest rate differentials or expected interest rate differentials moving in a particular way that leads to strength in other currencies other than the dollar. I mean, the dollar did strengthen when the Iran war started, fear, and now it's come back down, macro.
Diversification, though, is not displacement. Can anyone displace the dollar?
Not quite. I had a piece recently where I argued that, dollar dominance is something that the rest of the world hates, but dollar dominance is everybody else's fault. Essentially what the rest of the world could do is get its act together. Europe could get its act together, create a more cohesive economic zone, have more political cohesion. That would strengthen the euro. China could get its act together in terms of reducing capital controls, improving its institutional frameworks, thereby engendering the trust of foreign investors. But if you look around the world, this is not happening. Countries like Japan and the United Kingdom, which used to provide strong reserve currencies, are, to use your words, Lisa, a mess. So there really isn't very much out there. And at the moment, we are facing a situation where, because of volatility in international markets, paradoxically caused by the US itself, everybody wants a place to hide. So the talk of diversification is very strong out there. every central bank, every investor would like diversification. If you're a private investor, with a few $1 billion or tens of $1 billion to throw around, there are good alternatives, gold maybe. If you're a central bank, it's pretty hard to find a place to hide.
Professor, always an education. Thanks for being here. We appreciate it.
My pleasure.
Thank you very much. Eswar Prasad there of Cornell University and the author, let's sell some books, of The Doom Loop. Very cool. Thank you, Professor. Appreciate it. Let's give you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. China is asking its largest lenders to temporarily suspend new loans to 5 refineries recently sanctioned by the U.S. over ties to Iranian oil. The move contrasts notice from 4 days ago instructing companies to disregard U.S. sanctions. Meanwhile, shares of Shell are falling more than 2% in London trading. The company saying its profits surged in the first quarter as the Iran war boosted oil prices and trading, but it warned it expects second quarter production to decrease as a result of the closure of the Strait of Hormuz. And Germany's foreign minister telling Bloomberg News the tensions between Chancellor Merz and President Trump are a misunderstanding.
It is the attempt of Iran to humiliate the American president. And of course, that there is a risk that some of the international observers could see it like this.
He also said Berlin supports the U.S.'s demand that Iran does not obtain nuclear weapons. That's your Bloomberg Brief. John?
That was a diplomatic cleanup on aisle 3, right?
Seriously.
Seriously?
What, so they're not humiliating the President of the United States? It's their intent, their wish to.
It's a risk. It's a risk.
It's a risk.
It's a risk. It's not what he actually said. It's a risk.
Wow.
Up next on the program, searching for clarity.
Before the productivity has arrived, you can easily overheat the economy. And it's not at all obvious that the Fed would need to lower rates in that case. They might need to raise the rates.
Earl Davis of BMO is going to join us next to talk about the potential for interest rate hikes. That conversation just around the corner. Stocks, all-time highs, looking to add to them. We're up by 1/10% on the S&P 500. On the Nasdaq, up by 0.07. In the bond market, backing away from the highs of the year. 2s at 385, 10s at 433. Under surveillance this morning, searching for clarity.
If the productivity growth miracle is happening in an unexpected way, then it will mean lower inflation, and I think it means rates could go down. Before the productivity has arrived, you can easily overheat the economy in the here and now. And it's not at all obvious that the Fed would need to lower rates in that case. They might need to raise the rates in that case.
So here's the latest this morning. Uncertainty over inflation and productivity clouding the outlook for monetary policy. Earl Davis of BMO writing, we place a higher probability of a 2027 hike than an ease. Earl joins us now for more. Welcome to the program. Before we start hiking, we've got to drop an easing bias. And according to a headline just dropping across the Bloomberg terminal, one other Fed president actually supported the 3 who dissented against the language of the statement at last week's meeting. How close do you think we are to dropping that easing bias?
We're probably a solid 2 meetings away. At least I think the next meeting will maintain the bias, but we're close. You see where the tides are going. And what's interesting, like in regards to the inflation discussion and using your whack-a-mole analogy, we've been having an outstanding year across our funds, especially our strategic bond fund. And the reason why we're having that is that we're whacking at the hole before the mole's there. We're not whacking at the mole. We end up hitting the mole in the head. So the hole that we're looking at now, where the mole's not yet there, is inflation. We believe the inflation genie has been let out of the bottle. Not just because, as you've discussed, the supply shock. We also have the second order of that hitting, which will come through in food. You'll see it in chips and technology because of helium and the like. But we also have, so that's what you call cost push inflation. But now, based off the last clip that we've seen, we believe we're going to have demand pull inflation as well, too. And the reason why we're going to have demand pull is growth has been especially strong, surprisingly strong this year, and will get stronger because of the wealth effect. It's not just a U.S. wealth effect, it's a global wealth effect. So when you have demand pull and supply shock, you know what that is? That's COVID redux, supply shock, demand pull because of all the money in the economy. So we don't believe hikes are on the table for 2026. Definitely on the table for 2027. And not only that, I don't believe the discussion will be 25 basis point hikes just because they'll be so far behind the 2026 curve. You're going to be talking 50 plus hikes depending on where inflation is at that time. And because of that, right now we're positioned underweight duration and we're selling more as we get closer to 425. We're overweight credit because the growth outlook is good, which means your default probabilities don't get tighter. But we are looking to lighten up on our overweight of credit right now.
Oh, let's just sit on the underweight duration story. I just want to get an idea from you as to where you think yields might go through next year. It's an interesting theory. I just want to explore it further. If you've got them hiking and maybe by more than 25 basis points in 27, what kind of levels, numbers are you thinking about?
So what's interesting, and we could discuss it in terms of this year, which applies to next year. Our theory this year was that yields will remain in the range of 2025 10-year treasuries, which was 390 to 480. So 435 is the midpoint. Anything below 435 we're underweight, and the more it goes through 435, the more underweight we go, and vice versa. We're not buyers at above 435 until 450 to cover the short, and then we will start going long. We will have a disciplined pulse to start going long. We think 480 holds, but there's a definite possibility we hit 5%, not next year, this year. But we like being very overweight at those levels. The math and the of fixed income and owning 10-year, call it the Bloomberg Bloomberg Ag, U.S. Ag. The math gives you a lot of protection for another 100 basis points of hike. So if you buy at 5%, you probably have an active manager has 6% yield on their portfolio. You have 100 basis points of protection for additional hikes beyond that. And that's where we like owning bonds. We like owning them towards 480, and we like owning them towards 5%. We believe QE will come into play if we hit 5%, which gives you protection on the first time of being overweight duration.
Can you lean into that, Earl, just a little bit? How do you see the Kevin Warsh Fed handling a situation where the market's pushing back on rate cuts, but expecting intervention on the long end?
Yeah, I pushed upon that a little bit in regards, the longer they wait for hikes, the more they're going to have to hike. So it's going to make their job very difficult. Also, you have the Treasury versus the Fed, although they should be hand in glove with Warsh coming in. Don't think it has an effect, because the reason why the Fed will have to hike, and hike probably a lot more than the market thinks, is inflation expectations. One of the things of note recently, on the recent sell-off, we saw 10-year U.S. break-evens go above 250. They touched like 252, 253. They're now at 244. The last year high was 245. This is why we believe the inflation genie is out of the bottle. It's not yet the thing they're focused on, but it is the thing that the market will focus on, we believe, in Q4 this year.
Earl Davis of BMO, quite the conversation starter, looking for potentially 50 basis point hikes in 2027. I mentioned that the three dissenters got some additional support from another Fed president. That Fed president is the Boston Fed president, Susan Collins, in an interview with our colleagues in Bloomberg News.
Yeah, she said that she agreed with the dissenters and she would have preferred to adjust the wording. She doesn't think this Fed should have an easing bias.
Do you think this Fed should have an easing bias?
Right in.
Dan Skelly of Morgan Stanley. Do you want to start that? Phone in. We can do phone
That would be fantastic.
Phone would be great. Terry Haines of Pangaea Policy will join us too. We'll catch up with the Merrill Wealth Management President Eric Schimpf and Max Layton of Citi. The second hour of Bloomberg Surveillance. Up next.
There isn't really any sign of the labor market cracking right now.
They will see sufficient weakness in the labor market.
You really got to sort of think that inflation is going to be better than it has been.
We should be expecting inflation to go up initially.
We've run off the edge of the cliff. We're running through midair, but we have not yet had economic gravity pulling us down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equities, record highs, adding to them this morning by 0.1% on the S&P 500. The earnings super powerful from AMD, the Walt Disney Company, Uber. Tech is still investing, and consumers are still spending. In the commodity market, getting a helping hand from crude, Brent and WTI, south of triple digits. 98 on Brent, 92 on WTI. That's dragging yields lower, breaking away from the highs of the year on 10s and 30s. 30s back down to 492, 10s at 433. Later this morning, more economic data for you. The appetizer before the big one. Payrolls tomorrow morning. Later this morning, jobless claims at 8:30 Eastern Time.
We just saw the lowest reading for jobless claims in the previous reading since 1969. Do we get a repeat of that type of strength, a signal of strength, or we have basically broken this particular mechanism as an indicator of some sort of jobs market health? Ultimately, how does this market view an incredibly hot labor market? Is that a positive? Well, probably for equities. Is that a positive for bonds and for the Federal Reserve? Probably this makes this job that much more difficult, which again goes back to that bond stock dynamic. And at one point, yields start to bite into some of the stock optimism.
Well, let's just sit on the data just for now. Momentum in the ISMs. Jobless claims at multi-decade lows. Prices paid. The prices paid component of some of these PMIs, super elevated. So why do we have an easing bias of the Federal Reserve? People are talking about Chairman Walsh being recklessly dovish. Let's talk about this Federal Reserve, led by this chairman, with an easing bias at this Federal Reserve in the face of that, and some dissent, some growing dissent from more officials.
Yeah, the idea that Boston Fed President Susan Collins coming out and saying, had she been voting, she would have agreed with the dissenters, that she does think that inflationary pressures have increased. She was just speaking with some Bloomberg colleagues of ours. There is a feeling that this Federal Reserve has to adopt or leave its easing bias on the side of the room in order to move forward and really address the inflationary threat that a lot of other central banks seem to be recognizing, or else they risk an increasingly weaker dollar and potentially higher long-term yields. And that ultimately is the game that a lot of interest rate strategists are playing.
Boston Fed President Collins says she doesn't want this language to be associated with the presumption that the next move will be a cut. What does Kevin Warsh do when he walks in? Because there's going to be a tremendous amount of what feels like pressure almost for him to keep that easing bias at the Federal Reserve, especially at his first meeting, when clearly that is what this White House would like to see.
That meeting's difficult. They also have to put out some forecasts. It's difficult to forecast right now. Who knows where these talks will be with Iran? Who knows what the situation will be with energy? I've got no idea. They'll have to put some numbers on it in June, and that's a difficult task.
The key point for June is going to be who is Kevin Warsh and exactly how much of an easing bias does he adopt in the face of some of these inflationary pressures. That will have a material effect on markets worldwide.
Coming up this hour, we'll catch up with Dan Skelly of Morgan Stanley as tech pushes equities to new heights. Terry Haines of Pangaea Policy as President Trump declares victory over Iran. And Max Layton of Citi as crude settles below 100. We begin this hour with stocks holding on to record highs. Dan Skelly of Morgan Stanley writing, the market has treated domestic policy and geopolitical shocks almost like pop-up ads in a longer winding movie focused on AI and a resilient economy. Dan joins us now for more. Dan, good morning.
Good morning, John.
The market has been paying up to go ad-free. It's getting expensive on the tech side of things. Do you like that? I was thinking about that when I read that quote. Thank you. I'll move on. Has anyone said no? OK. I wanted some praise here. No?
That was great. That was so good.
Thank
Great
you so
job.
much.
That was
Thank you.
great.
I
love the quote. In my mind, I was
really
thinking, like, if only
like,
that could be real. Can I X out of these pop-up,
On Hormuz?
Yes.
Anyway, OK.
2026.
I'll start again. My goodness. Get engaged.
All right. Me?
Yes.
OK.
Thank you so much. Thank you so much. All right. Good to see you. Likewise. Good morning. How expensive is tech right now?
Yeah, so John, tech has really been the story for the past several weeks and really going on for a long time now. And the story clearly within tech is semis. And I think what has surprised folks is not so much the rate of CapEx continuing to accelerate every quarter. We've kind of grown accustomed to that. It's kind of like this tradition every quarter now with the hyperscalers. What has surprised people is more two things. One is we're just coming out of this massive trade war last year, and yet we import 90% of the components for semis, memory, tech hardware. And so I think the flow of trade and getting all the goods has been surprising. And number two, it's about this rotation within semis. 3 years ago, GPUs. A year ago, memory chips. And now, CPUs. So it's back to the future. And that's the part that's caught people off guard, is the rotation.
And this massive move we've seen in some of these chip players is just crazy. AMD exploded. The CPU story, we were talking about that yesterday. Do you think if we can address the situation through the Strait of Hormuz in the Middle East, and we can actually move on. That's no longer just a pop-up badge we want to X out. If we move on, that we will trigger a rotation back to the other stories again. We go back to where we were at the start of the year.
Yeah, and Jonathan, it's almost as if the market has seen the U.S. flip its cards already in terms of the ceasefire. And I think the reaction, maybe not unfairly at first, was, is this a replay of Russia-Ukraine 4 years ago? When we were thinking, could this go on for a long time? Could it be a forever war, a stalemate? And so, look, I think two things. Number one is, we were telling people to stay the course 5 weeks ago because, number one, we were saying we could deal with high oil prices. We have a K-shaped economy, which we've talked about ad nauseum. The higher income consumer continues to take the lion's share of total spend. And secondly, we never thought the conflict would go on forever. We thought it would be more limited. So the market has almost kind of moved on, and that's been definitely corroborated by the backwardation in the oil futures curve that are still around $80 by the end of this year.
The market has moved on from the conflict, but there's certain economic ramifications that could be somewhat lasting. And inflation is a significant part of that, especially given the fact that all of the increased prices that a lot of companies have experienced, they've been able to pass along to their consumers. At what point does that become a headwind to the story a bit more than it would have been earlier this year?
So, good morning, Lisa. And so I think it's an excellent question. My point would be thinking about stocks. Stocks are a nominal asset. They are a nominal claim on a real asset. And so I think your issue is more in terms of within stocks, you have to favor companies with pricing power. And you have to be a little bit more kind of keen on other asset classes, maybe fixed income, that doesn't have that type of pricing power. And I think your broader point in terms of when does this affect the economy, look, we've continued to see a lot of people absorb higher travel and airline tickets. We've seen people absorb higher food prices. And we would just argue there is a new range for energy prices, probably 80 being the floor and 100 being the ceiling. If we go much past 100 and the ceiling collapses, that's a problem. But we don't see the issue yet.
Yeah, and that's one of the reasons why I was distracted from fully applauding John's joke. That was the McDonald's earnings to come out.
Do you know what I remember?
Yes.
Do you remember Jeb Bush when
Yes.
he said, please clap? Yeah. That was one, honestly.
That was what you were doing?
The greatest moments of political campaigning I've ever seen.
So you wanted to replicate
Your
that this
campaign was
morning.
bombing so hard. You've planned the speech. You've got the joke. In the speech, it says, wait for applause. And he turns around and says, please clap.
Okay, well,
We don't talk about that moment enough.
This is why it's better sometimes when politicians actually do what Trump does.
McDonald's, forgive me.
No, I was looking at McDonald's, and they just came out, and comp sales actually missed, which is notable, given the fact that earnings per share actually beat across the board, and a pretty big beat. And they were talking about how they're emphasizing higher margin items. I just wonder how long some of the consumer-facing brands can keep doing this. The whole idea of higher margins, the whole idea of being able to raise prices for a select group of people to pad things out, because there are a lot of people who just are not coming to their doors.
So I think that McDonald's in particular has one of the highest skews to Europe in particular. And so if you think about just the broad global consumer spectrum, clearly higher oil prices are an issue everywhere, but I would argue they're exacerbated overseas. So that's number one. Number two is when you think about different business models, we've continued to favor what we call the RAG 6, which is a riff on MAG 7, which are these platforms in the U.S., the big box platforms across retail, food, housing. And the reality is they have the best value for your money type franchise out there, and they've continued to lower prices. And so McDonald's may be going in the opposite direction, trying to look for higher margin products. We've, again, continued to favor these broad consumer platforms that are just continuing to aggregate market share across the consumer throughput.
Is that a sign that the economy is not doing that well if you have some of these big retailers having to lower prices?
Not necessarily, because if you think about it, yeah, you're seeing some of the higher income folks trade down, but their core customers continue to come back, and they're, unlike the name you just referenced, they're continuing to see an acceleration in comps and same-store sales. And beyond that, they're the ones who also are able to reinvest, much like the MAG 7 from years ago. They're utilizing their excess market share to reinvest in the business vis-a-vis omnichannel and all these membership-type businesses. So what are they doing? They're accruing recurring revenue streams, and that's another way they're offsetting cyclical ebbs and flows in the consumer.
What are you calling them again? What's the
RAG 6?
The RAG 6. Okay, don't laugh at him.
I'm not laughing at
Where's
him.
my
but
laugh
I know,
track?
But the thing is that please clap.
It's like North Korea. It's turning it to North Korea.
Exactly.
That's not the comparison that we want. He's talking about Walmart. He's talking about Amazon. He's talking about the others, which are actually becoming tech companies as well. So that's also the way that they can consolidate market share. Again, though, it becomes the haves and the have-nots once more.
Please clap. It's good to see you, Dan.
Likewise.
Thank you, sir. Thank you very much. Good morning, Lisa. I love that every single time. Every single time. Dan Skelly, constructive.
Yeah,
Lisa, super bearish. Good morning, Lisa. Dan Skelly and Morgan Stanley there. Let's get you an update on news worldwide. Your Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. The Trump administration is looking at using oil under U.S. military bases to refill the nation's emergency reserves. Sources telling us here at Bloomberg, no decision has been made on the initiative. The SPR is poised to reach its lowest level since 1982. Meanwhile, McDonald's shares are rising 3% in the pre-market. The fast food giants reporting first quarter sales that fell just short of expectations, but did show a rebound from a year ago. EPS also beating. The company said larger orders boosted U.S. results, helped by pricier items like its hearty Big Arch. And in sports, the matchup is set for the Champions League final. PSG is looking for back-to-back trophies after beating Bayern 6-5 in the aggregate. They'll be taking on Arsenal, who held on to beat Atletico. The match is set for May 30th. That's your Bloomberg brief, John.
That should have been the final. It really should have been. Bayern Munich, PSG. Fantastic, fantastic two legs of football in the last couple of weeks.
That there are people who watched it. I actually didn't watch it, but people are very excited.
People at Casa Bramo.
People at Casa Bramo.
Okay. What was the feedback like? Good game? Enjoyed it?
Incredible game.
You see Bank of America this morning?
Yes. France will win this year's FIFA World Cup, they say.
Yeah.
Evidently,
but Dan Skelly says AI, it's Spain.
Oh, okay.
So we can actively bet human versus AI.
So is this a Morgan Stanley take or is this a Dan Skelly take?
This is an AI take.
Okay.
According to the Merrill note.
Oh, right. Okay.
Yeah.
Got it. No, I know. Yeah, okay.
Please clap.
The real story is Arsenal, isn't it?
Yes. Is that your team?
No.
Okay.
My team is the Knicks at this point.
Let's go. Knicks in 6.
The one game too?
Yes.
Very cool. All right.
It's closer, though.
Yeah.
It's scary.
It wasn't like that 50, 60 point gap?
It was closer.
Okay.
And OG potentially
Do you want to clap for the Knicks as well?
OG potentially,
I think they want us to go.
OG potentially has an injury, so I know Friday is going to be a little rough.
happened?
Up next on the program, winding down the war with Iran.
They want to make a deal badly, and we'll see if we get there. Their leaders are all dead, so I think we won. Iran cannot have a nuclear weapon, and they won't. And they've agreed to that.
Terry Haines of Pangaea Policy joins us next. In the commercial break, we'll attempt to get the show back on the rails from New York City this morning. Good morning. I didn't know this, but Bloomberg Intelligence apparently has a Please Clap weekly ETF update that they send out as a newsletter every week with a picture of Jeb Bush up. I had no idea that existed until now.
Well, it should be great reading. Is it a politically motivated ETF?
No, I don't believe it is. Agricultural ETFs. The White House portfolios of performance.
Yeah, there we go.
Part of it.
Yeah, so, you know.
I'm reading the note now. I shouldn't be, but interesting. Equity futures right now in the S&P, positive about 1/10%, just about unchanged on the Nasdaq this morning. Turn to commodities. Just a quick update on crude for you. For a third consecutive session, Brent crude lower by 2.5%. We're down to 98. We were lower than that yesterday, briefly breaking 90 on WTI. We're down by 3 percentage points so far this morning.
People are taking the signal and running with it, which is that this White House wants to be done with the war and ultimately want to come to the table. Key questions and concerns linger in terms of, will Iran come to the table and will they actually be able to agree on anything? And frankly, the bigger question, how long before ships actually start to go through the Strait of Hormuz?
Under surveillance this morning, winding down the war with Iran.
No, they want to make a deal badly. And we'll see if we get there. If we get there, they can't have nuclear weapons. You know, it's very simple. But what's not to submit? Their leaders are all dead. So I think we won. Iran cannot have a nuclear weapon. And they won't. And they've agreed to that, among other things.
So here's the latest this morning. President Trump saying an agreement with Iran could be reached within a week, with Tehran expected to respond to Washington's proposal at some point in the next day. Bloomberg's Tyler Kendall has the latest in Washington. Good morning, Tyler.
Hey, John, good morning. Well, at least publicly, the two sides still feel very far apart, though the White House does maintain that a deal will get done. Our reporting does indicate that there are active discussions about a potential moratorium on Iran's uranium enrichment capabilities, but Iranian officials have long maintained that there will not be any concessions related to its nuclear program. Though before we can get there, this one-page memorandum of understanding would first see a gradual reopening of the Strait of Hormuz, with the U.S. lifting its naval blockade, which at this point is still very much in place. In fact, CENTCOM just yesterday confirmed that the U.S. military has disabled another Iranian-flagged oil tanker that was trying to transit through the Gulf of Oman, because conditions right now related to the Strait of Hormuz is really compounding that domestic pressure that this White House is feeling when it comes to the conflict, as the Wall Street Journal is now reporting that at least privately, senior advisors to President Trump are growing increasingly worried that the rising cost in fuel is going to cause Republicans to pay a political price as we get closer to the midterms. In fact, just this week, a new poll out from Marist College finds that nearly 8 in 10 Americans say that higher prices at the pump are putting a strain on their household financials. And John, of course, it's not just domestic pressure that is building on President Trump, but also foreign policy pressure as well, as he gets ready to head to Beijing next week to meet with Chinese President Xi Jinping. President Trump told reporters just yesterday that he thinks there's a, quote, very good chance a deal can get done before then. As our analysts at Bloomberg Economics say, the recent visit by Iran's foreign minister to China does signal that the country wants to get more involved in the diplomatic efforts.
Tyler, thank you. Thanks for the update. Appreciate it. Tyler Kendall, down in the nation's capital. Terry Haines of Pangaea Policy writing, we put the potential for snapback to hostilities as more than a trading risk, at least. Terry joins us now for more. Terry, welcome to the program. This White House seems pretty committed to de-escalation. They had the opportunity to escalate things earlier this week when things got volatile. What would it take to resume hostilities?
Well, I'll take in answering that question, John, I'll take the other side of that argument. I think the White House would very much like to de-escalate, but they want to de-escalate based on Iran not getting a nuke and the Strait of Hormuz reopening. So as long as Iran won't agree to that, they're going to continue to do that, or continue to push. And they're also, continuing to ratchet up the economic pressure on Iran. One way to look at this is that the White House is betting that the economic pressure on Iran causes Iran to buckle before there are serious consequences worldwide. But fundamentally, if Iran remains recalcitrant on any of this stuff and sticks to it, then I think you are at least likely to see not just rhetoric on ramping up. I think you're likely to see some action to show people that in Iran that the United States is serious about this.
Terry, though, when it comes to this one-pager, a lot of reporting about it basically outlines something very similar to the JCPOA. How is that in and of itself acceptable to this White House?
Well, I think there's a lot of crossfire reporting on this, Annmarie, frankly. You get the kind of memorandum of understanding, and at the same time, the memorandum of understanding is supposed to describe a condition where serious negotiations will start based on that memorandum. So, there's a lot of gauze here. And Trump is trying to limit their options in order to provide more progress and ultimately get them to a deal. But, the way I would look at that is, I don't think that's certainly the base acceptable condition to the United States. Equally importantly, I don't think it's a base acceptable condition to our Gulf allies who very much want to see the Iran genie put back in the bottle, and for a generation at least, and want a situation where they don't have to worry about Iran as a threat overall.
But when it comes to this White House, they're clearly concerned about how stocks around the world are being drawn down when it comes to fuel and other gasoline products and the midterm elections. How are they weighing both these options? Because obviously, if you escalate in terms of kinetic hostilities, that's going to be an increase in oil prices.
Well, yeah, of course they're concerned about the economy, and they should be. But at the same time, I think it bears understanding that they're not concerned just about the economy. There's a long litany of things that we all could say, you all have said on air, I've said, there lots of downsides for Trump going into this, and yet they did it anyway. So there's a there is a geopolitical problem here, the Iran nuke problem, and now the Strait problem, that is underappreciated, I think, in a lot of this, and was considered by this White House to be so important that all the downsides, didn't balance it out.
Terry, are we gauging the potential political ramifications correctly here? Yesterday, we saw the Indiana and Ohio primaries, actually on Tuesday, but yesterday we got the actual results. And some of the candidates that President Trump supported, even at the behest of incumbents, were the winners. It seemed to indicate that President Trump still has quite the clutch over the Republican Party. Are we overestimating the political loss from this conflict in the midterms?
Today, I think so, Lisa, on behalf or for a number of reasons. One is that Trump showed in Indiana that the base will come out and the base will be motivated to give him what he wants. So you consider that a counter to the enthusiasm gap that so far has favored Democrats. Secondly, on the redistricting business, there's a lot of people who come on and will tell you, the Republicans are going to lose this and all the rest. Redistricting affects potentially as many as 200 out of 435 seats in the House, firstly. Secondly, if you bring all those redistrictings together, it comes up with assuming that the districts stay R or D, it comes up with a very tiny R advantage. Today, I think it's +3, +4, something like that. But either way, there aren't going to be massive swings in the House, and in the Senate, what it looks like is that the progressive left, with people like Graham Plattner and the gentleman in Michigan who's running, are taking over, but really in doing that are ceding the center to people like Susan Collins. Also, that's also not good for Democrats. So, I'd urge everybody to take a breath on the narrative.
What does that imply for policy that maybe people are underpricing?
I think what it implies for policy is a couple of things. One is that if there's a continued Republican Washington, all R Washington, then legislation can continue as well as regulation. I think what markets are pricing in today is that majority in at least one house goes away, but even in that scenario, regulation continues. But if there's an all-R Washington, then you should consider that animal spirits will continue to be up, because there will continue to be optimism about the possibility of Trump continuing to stoke the economy and kind of bring it back to a position of greater dynamism than there was before.
Terry, quick final question. Can you believe it's been 10 years since Please Clap of Jeb Bush in New Hampshire? 10 years.
I'm so glad you brought that up, and just because it's great. And then we can also throw a lot of the Biden ones in, though. The quality of mercy is not strained, and the quality of politicians are clearly going down.
It's been quite a decade, hasn't it? Terry, thank you, sir. Yeah. Terry Haines there of Pangaea Policy at the Hanover Hotel in Hanover, New Hampshire on February 2nd, 2016. This is what the media, the spokesperson for the Bush campaign said at the time, that the media had mischaracterized the event, describing Please Clap as a charming moment.
Well, clearly, we're still talking about it, so it kind of is like the screen.
It would be charming if Jeb Bush was charming.
Oh, AMH.
Oof,
brutal.
Has the,
Jeb's already taken some heat already this morning.
There are all sorts of moments, right? It's like the Howard Dean.
That's the one that always comes up.
Yeah.
But I think the Jeb Bush moment.
I think that's actually better.
Yeah.
Yeah, because that was just enthusiasm.
I promise we won't talk about it again, okay? Up next, we'll catch up with the wealth management president of Merrill. Up next, Eric Schimpf. Equity futures on the S&P just about positive here by close to 0.1% on the S&P 500 coming into Thursday. All-time highs on the Nasdaq, just about unchanged. We've said this a few times already this morning. The earnings story of the last 24 hours has been so powerful. AMD, and not just tech. You mentioned Walt Disney. You mentioned Uber. The consumer is still spending, and big tech, of course, is still investing.
DoorDash, perfect poster child for this. Some people are ordering food, and they're ordering food a lot, even though you have to pay a fee, and even if you cancel, you don't get your money back necessarily. So if people are just paying as much as they can to order food for the privilege of having someone else bring their food to their doors, and they're willing to pay up for it, it gives you a sense of where we are.
Some people. Okay.
Is this you?
Please clap.
It's definitely me. I own it.
The please clap moment is just.
I know. I told
promise
you it
we'd
wasn't
move on,
going
but
away.
you
Anyway.
Okay.
It's not me.
Just took us right back in there.
I walk. I go pick it up.
Oh, do you?
It's good for your body.
But then you build a relationship with the restaurant too, and I think that's important.
No, that's.
There's a restaurant that I really like in Manhattan, and every Friday I would order from there, and I guarantee they've got no idea who we are. And every single week we'd order from there.
And then, but you've got a relationship with DoorDash, which
no
is their
relationship.
I do like picking
whatsoever.
up. I used to go to this one place in London. I used to pick it up. I moved, came back and visited, and they said we had no idea where you went. They were actually nervous about me, my safety.
This was in London?
Yeah, you know
I've been to that restaurant with you, yes.
Yeah, Nora.
In Mayfair. Okay.
There you go.
There you go.
Wonderful Lebanese food.
Okay, Anne-Marie's kind of restaurant. That's the score in the equity market. Let's turn to crude. Brent WTI. Brent crude down for a third consecutive session. 97 handle on Brent. We're down by more than 3%. This is where things stand. We could be signing a one-page memorandum of understanding. The US has proposed something. We're waiting for the Iranian response to it through Pakistani mediators, and that could happen in the next 24 hours.
Dan Skelly really summed it up well, that people are viewing geopolitics as a pop-up button and are trying to just pop out of the advertisement that keeps popping up. And that's the reason why you see markets responding so significantly to a deal that still has a lot of work to do to get over the finish line.
That move in crude helping this move in bonds. Yields lower across the curve. 2's down 2, 10's down 2 as well. 433 on 10s this morning. The 2-year at 385. If you missed it earlier on this morning, we had those 3 dissents to the statement at the Federal Reserve a week ago. They want to remove the easing bias. We spoke to the Boston Fed president, President Collins, and she supported those dissents, so that there are others on the committee that would like to drop that easing bias.
The bigger surprise for a lot of people in markets is why there wasn't more agreement to drop the easing bias, given the fact that you've got inflationary pressures. The Norwegian bank hiked rates, and it was surprising to a lot of people. The Australian bank, central bank, hiked rates. They're seeing inflation pressures, also a robust labor market. We see a robust labor market tomorrow. What can this Fed do in terms of continuing to maintain that easing bias?
And to Kevin Walsh, welcome to the Federal Reserve. Big job ahead of him. As we count you down to the opening bell, 2 hours away, let's get you some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, some more earnings for you, but this one to the downside. ARM had been participating in this really powerful chip rally. In fact, it's up over 100% year to date, so not surprising that you get a miss. Overall, their earnings did beat, but it was a miss on the royalties around iPhones. Also, they're having a crunch in supply constraints for AI chips. Too much demand, not enough there. So you see shares fall 8.3%. But again, after a huge rally in this equity stock. At the same time, we got McDonald's earnings. Those were better than expected. A very clean beat across the board. Their global sales rebounded after falling last quarter. It seems that the bulk of the gains came from their more value-oriented products and their Big Arch Burger, despite that very cringy video from the CEO that apparently did not dent any earnings. So those shares up more than 3%. Finally, rounding things up with another earning this morning, Unity Software. There's about $11 billion company. They do AI. They have a platform that does AI-powered mobile advertising, and that was really, really strong for them. So again, it's one of these companies that can show up and say, hey, here's where our AI capabilities are adding to our results. Those shares up 2.33%. John.
Hey, Danny, thank you. Thank you for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump declaring victory over Iran, expecting a peace deal to be finalized within a week. The president claiming the U.S. has had good talks with negotiators and that Tehran agrees it cannot have nuclear weapons. Elsewhere, the GameStop CEO, Ryan Cohen, claiming eBay suspended his account. The alleged ban coming after Cohen listed personal items, including a pair of socks and life-sized Halo 2 statue, to help fund his $56 billion bid for the company. And finally, Anthropic, partnering with Elon Musk SpaceX, signing a landmark deal to access the Colossus One data center. The move is expected to boost computing power for Anthropic's Claude AI, allowing the company to raise usage limits and meet some surging demand.
Elon Musk said that he agreed to this after making sure that Claude is good for humanity, saying that no one set off my evil detector. So long as they engage in critical self-examination, Claude will probably be good. Look, first of all, it is clear that the likes of Anthropic and OpenAI, who clearly that was trying to throw shade at, is giving a lot of people business in terms of the compute world. They have a lot of desire for compute, and they are, to your point, kind of holding up a lot of the ecosystem in terms of demand for some of this energy. They all need to work together, a lot of personalities. I'm just curious what happens when one gains clout to the other. I mean, are we overbuilding? That kind of goes to all of these questions.
Also, it's interesting because Anthropic is also going to be competing with Elon Musk when it comes to the DoD, when it comes to XAI and Grok. But at this moment, he's willing to team up with them. And I think it's easy. He says, no one set off my evil detector. I think partially is because of OpenAI, but also maybe partially because what did we hear from Emil Michael at the Department of Defense?
Some strong words.
Yeah, saying that the CEO of Anthropic has a God complex.
This is the theme supporting this equity market right now, not the back and forth between these leaders, the earnings. The earnings and the investment we're seeing in big tech with stocks at all-time highs. The Merrill Wealth Management President, Eric Schimpf, writing this: profits have surprised to the upside and forward estimates have been moving higher, helping offset the uncertainty. Eric joins us now for more. Eric, good morning and welcome to the program.
Yeah, good morning. Good to see you. Usually, guys, you come our way, but it's nice to.
Well, it's nice for you to come to the studio and
nice
do a return visit.
Yeah.
What are the client balances now? Close to $4 trillion?
Correct. Yeah.
You've got a lot of insight across a lot of money. Just describe the last 2 months. What have people been doing?
Yeah, if you would have thought, right, from where we are into March to all-time highs today, clients have sort of said, hey, this is kind of contained. And as you guys have been talking about this morning, earnings have been driving this story. And clients have been putting money at risk, right? They've been adding risk to their portfolio.
To talk about this too, you're a West Point grad.
It's true.
It would be easy for you to get lost in these headlines and focus on the geopolitics. How have you parked that and focused on what's really driving stocks right now?
Again, I think the market likes certainty, but this is sort of contained, and the underlying fundamentals have been so strong. Earnings power, spending, sort of stable interest rates, earnings revisions to the upside. It's just driven this thing, and I think when it's said and done, if the earnings headlines or the headlines sort of go away, this thing is continued to go. There's a lot of power behind it.
Can you cross that kind of financial reality with the reality on the ground that we're hearing in parts of Asia and even potentially in Europe of physical shortages and what that is doing in terms of crimping certain flights, say, of Lufthansa from certain regional cities, or some of the potential issues that are constraining growth in other parts of the world?
I think it just comes down to selection, right? And you have to pay attention to things that are going on. And there's pockets that I'm sure will have some weakness and pockets that won't be great. But I lead 12,000 wonderful financial advisors, right? And everybody should have a financial plan, and everyone should have something tailored for their risk tolerance and their ability to invest. I think there's plenty of areas that are set to do quite well.
How much are we underestimating the money supply? I mean, whenever we talk to people, they're like, well, people want to take risk. Is it just that there's so much liquidity right now in the system that we just have no concept of how much really is looking to be put to work? And so ultimately, any sign of positivity is going to unleash this huge cash flow.
I think it's exactly what's happening. And, Jonathan mentioned, when I first started, every time we check in, how are the balances? Jonathan always starts with that question. And he mentioned $4 trillion. There's a portion of that sits in cash. And I would say probably elevated more than historically you would think. And it's sitting there ready to go. And we see it every time there's a dip, every time there's a move. Clients want to put risk on, again, based on the planning that they've done in advance of something like that. But cash is sitting there, and I think it's ready to go.
We've had a series of supply-side shocks that have upset the bond market, and there's clearly a pretty tight correlation between equities and bonds right now. Yeah. And we've seen how leveraged the developed market rate story is to the price of crude. Yeah. How does that change the approach to equities and bonds in a portfolio right now? How are you working around that story?
Again, when my job is to lead advisors who give as much advice as they can to as many Americans as they can, and it's tailored and it's individual. And the advice we give isn't really driven on a 2-month, 3-month, 6-month cycle. We're helping people invest over years.
This has been a 5-year story now, though. where we've seen this correlation between stocks and bonds every time we get a supply-side shock, and we keep seeing more of them. Now, if I'm a long-term investor, someone trying to invest money for my retirement, do I need to rethink my bond allocation with that in mind?
I think it will continue to be an equity story as we go forward. And again, if headlines settle down and earnings keep continuing, we're going to be right there saying, you probably should continue to allocate more to equities.
When you say headlines, you mean the uncertainty of what's going on because of Washington. Have you ever seen a moment like this where day in, day out, is this what clients continuously ask you about?
Well, there's definitely a cycle, right, that has seemed to be quicker, right? News coming at us 24 hours, sometimes in the middle of the day, things will change. They ask, but again, it comes back to what is the long-term goal? What is the long-term plan? Because there's always going to be a headline, right? There's an energy, we've talked about energy prices. We've talked about the Middle East. Midterm elections there's always something out there. But as long as the investor can say, that's sort of contained, it's compartmentalized, earnings, as John was saying at the beginning of the top of the segment, earnings will drive this thing higher and higher.
It's transitory until it's not. Right. And just to pick up on the idea of 60-40, this question of are we in a new inflationary regime keeps coming up. We have an inflation above 5%, above 2% for 5 years. We're now exceeding that. We now have inflation expectations that are ticking upward if you look at the break-even rates. How do you address clients who say, are we in a new higher inflation regime that changes the calculus of what safe havens look like?
Listen, I think it's paying attention to interest rates is extremely important. We're sort of at this, I think, little bit of a crossroad, right? And I actually think you could maybe see a lightening of rates later on in the year. I think it could happen. You stay the course, you build a portfolio over time, and if we see weakness, I would tell you to maybe tilt a little more into the equity side.
Were you at the Knicks game last night?
Yes. How'd you know?
Just indulge Annmarie.
Yeah, tell us about it.
Come on.
Listen, I'm a huge Knicks fan. I've been a Knicks fan forever. I love the Knicks. I love when they win because of what it does to the city, right? You come outside of that game and people are... I wish they would have won a little earlier in the evening. 'Cause it makes it... but yeah, I've been a lifelong Knicks fan, season ticket holder. And
how many people have been tapping you up for World Cup tickets?
It's big. So it's we're excited to be one of the primary sponsors of the FIFA World Cup that's coming here to North America. And honestly, Jonathan, it surprised me. I'm a huge sports fan, as you know. Maybe, I'm learning the game of soccer, but I have been surprised how well it's been received and how people are excited about it. Yeah, and there's maybe an email or two.
I think that explains the price of tickets over at MetLife, right?
Yeah.
I was going to say, people tap him because they want free tickets. They won't pay $5,000 for the ticket. That's the real issue. But just say.
Seriously, Eric,
I'm excited, and I've chosen, go USA. They're going to win it all.
That's your call. That's a bold call.
That is bold. Okay. Merrill research, right?
Eric, stick to stocks. Eric, it's good to see you. Thank you, sir.
Thanks again for having me.
Hey, thank you for being here. Eric Schimpf there, the president of Merrill Wealth Management. Let's give you an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. In the labor market, U.S. job cut announcements falling nearly 21% in April compared to the same period last year. Challenger Gray and Christmas reporting just under 84,000 layoffs in the month, with most of that coming from the tech industry. UBS CEO Sergio Erromati isn't ruling out buying another firm as a way to boost its business here in the Americas. The Swiss lender has been working for years to turn around its wealth business in the U.S. UBS chairman Colm Kelleher has said the bank would eventually look to buy another U.S. wealth manager. And Wall Street bonuses are projected to jump for the third year in a row. Incentive pay for deal-making bankers is poised to be up 10 to 20% from a year earlier, while bankers who help companies raise equity are likely to see a similar bump. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, a crude wake-up call.
Refiners who are now buying because we're entering the peak season are going to continue to buy at high prices. So we are looking at higher prices longer, regardless of what we're seeing in the futures market now.
Up next, we'll catch up with Max Layton of Citi from New York City. You're watching Bloomberg TV. Equity futures here positive by 0.1% on the S&P 500. Headline just dropped around Citi, planning to buy $30 billion in shares. Planning to buy back $30 billion in shares. That headline just crossing moments ago. A multi-year buyback program starting in the second quarter, Lisa.
Yeah, shares lowered by about 3.6%. They also are talking about their ROTCE, return on capital, led to 11% to 13%. For 2027 and 2028. So they're talking about some of their targets, and you're seeing a response in markets as a result.
Just on buybacks, Savita Subramanian of Bank of America has put out some research on this, and I think it's interesting. Citi, by the way, down 4% to Lisa's point, but just on buybacks more broadly. This is the quote: "Say goodbye to the equity shrinkage bull case. Since the early 2000s, a confidence of factors systematically reduced available public equity year after year." That's including buybacks, by the way. She says this, though, and this is what to watch for. "An issuance deluge may be imminent. The three largest private companies represent more than $2 trillion of market cap." Now, it's not a story for like next week, next month, but maybe on a multi-year basis, that story, that tide's starting to turn.
There has been an equity scarcity, if you will, over the past 4 years or so, with companies like Citigroup planning to buy back their shares. A lot of these buyback programs have been expected. Now we've got the IPO potentially of OpenAI, of Anthropic, of SpaceX, and you're talking about a deluge, to your point, and to Savita's point, of new equities coming to market. How does that influence some of the valuations? Right now, it seems like companies still are buying back their shares, but that dynamic is waning as some of the tailwind of the U.S. equity
Big
market.
tech spending more on capex, shifting a focus away from capital returns.
Yeah.
Things are really changing. That's the equity story. Equity futures positive by close to 0.1%, record highs. In the commodity market, Brent and WTI pulling back. Brent below triple digits, $98 a barrel this morning. At the front end of the futures curve, we're down by more than 3%. Under surveillance this morning, a crude wake-up call.
The futures market can reprice instantly. They can reprice as fast as a trader can hit the sell button on their keyboard. Vessels that have been diverted away from the Persian Gulf are going to remain diverted. Refiners who are now buying because we're entering the peak season are going to continue to buy at high prices. So we are looking at higher prices longer, regardless of what we're seeing in the futures market now.
So here's the latest this morning. Oil hovering near triple digits after plunging on hopes of a deal between the US and Iran. Max Layton of Citi joined us now for more. Max, welcome to the program. Hopium will drive the paper market. It will not help demand and supply clear at spot. Can we start with physical? How tight are things still? What kind of prices are people paying up for physical barrels?
Sure. Yeah. So the physical barrel price isn't too much higher than the futures price, actually. We've had a lot of questions about that particular subject over the last couple of weeks. And, it reminded me of what happened back in 2020 when oil went negative at WTI. Actually, across the USA, physical barrels went negative and priced negative that day and the next day across the US, even though they didn't fill up on storage. And the point I'm trying to make here is that actually there's a lot of information in the futures price. People talk a lot about how spot price is the real physical price, but the spot price, this physical price, actually, for example, in the second quarter 2020, actually priced off the futures price. So I'm not sure it's as clear cut as, hey, all the information's in spot, because a lot of the spot people, they will be trading based on where the futures are.
Max, this is really important. I just want to build on that because most people thought, particularly in the commodity market, that we'd see paper prices converge up to physical, but physical has converged down to paper markets, right?
Yep.
And that's despite, Max, the Strait still being closed.
Yeah, and look, a lot of it is to do with I think the fact that there's, it's quite binary in some ways. It's very difficult to predict if, in particular, the IRGC leader Vahidi and Mojtaba Khamenei are going to do a deal or not. And I think it's fairly clear the US would like to deal, certainly, on their terms. But in that environment where you basically don't know if there's going to be a deal or not, very difficult to predict with this new leadership in Iran. You're going to be subject to news and you're going to be moving around like crazy. Like a week ago, we were trading 125 front month and we're now at 98 and it's on some hope of a deal, hope that we'll talk about a deal.
But putting a deal to aside, the actual physical market, basically what you're saying in terms of if the physical market is coming down to where the futures market is, that basically shows that the world has enough oil right now, doesn't it?
Well, I mean, it does. Over the last couple of months, what we've actually lost in physical barrels is less than what we built over the preceding 12 months. So there was a decent buffer that we built up in the vicinity of 800 million barrels globally. Now, most of that built in China, but even still, globally, we built some significant barrels in the lead up to this, and we're kind of eating through that aggressively. Physically, the impact is going to be much more kind of spread out over time. So for example, even if there was a deal today, it would take at least a couple of months to ramp back up production, to clear mines, to do all those kind of logistical things. And you would roughly double the losses that we've already seen over the last 2 months, over the next 2 months. So physically, it's going to happen over time. Yeah, and I mean that. And the other big thing is obviously as you draw the inventories, there's a convex relationship between inventories and price. So, you know, so initially we're just drawing what we built over the preceding 12 leading up to the conflict, but eventually, certainly by the time you get into the third quarter, and that's why a lot of people are, you know, talking about that being the pinch point, then you can potentially get inventories down to levels which are consistent with, you know, $150 to $180 Brent, $200 plus product prices, that kind of thing. So that pull is a bit more gradual.
Max, just real quick here, what would it take for you to actually lower your forecast for oil prices, given that you seem to see the market as much more realistic than other commodity strategists?
Yeah, so look, I think it's all about, for me, it's about any signs that this regime is going to do a deal, and that they're essentially going to put, I guess, you know, one of the benefits of them doing a quick deal is it can be tied to legitimacy, that they don't want to disrupt the global economy and that they'd rather do a deal and in exchange for obviously reduced sanctions and a number of other monetary benefits. So I think any sign, because to me, when I take this to an extreme, I think this regime can last not just months. I think this regime can last under blockade for years. It's plausible that they simply print money and prioritize that money towards the pro-regime portion of the population, and so when you think about it from that perspective, this regime, a lot of the choice about when they deal, how they deal, is up to them.
Hey, Max, we'll leave it there. It's good to hear from you. Max Layton there of Citi. A conversation about crude just as this headline drops, that the DOJ is probing $2.6 billion in oil trades related to the war in Iran. This from ABC just moments ago. We'll spend some time on that headline in just a moment. This story is really important. Up next, we'll catch up with Liz Ann Sonders of Charles Schwab, McHugh of PSP Growth, Nela Richardson of ADP, Cameron Dawson of NewEdge Wealth. The third hour of Bloomberg Surveillance just around the corner.
It's been a spectacular earnings season so far.
The equity market is being driven by corporate earnings.
You've still got a little bit of upside.
We're still maximum overweight in equities.
Short term, it's a bit more consolidation. We like the market longer term.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs coming into Thursday, adding to them so far this morning. Up 0.1% on the S&P 500, unchanged on the Nasdaq. Sneak peek of crude, pulling back for a third consecutive session. Brent crude, 98 handle. WTI at 91. That move once again unlocking this move in fixed income. Yields lower again by 2 basis points at the front end of the curve. 10s down 2 basis points as well. In 30 minutes, we'll talk about the economic data. Jobless claims at 8:30 Eastern Time. Ahead of payrolls tomorrow morning. big conversation about the labour market in the next 24 hours. I actually want to start the next hour with this story coming from ABC just moments ago. This is really, really important. I know how many of you have been very frustrated about the price action around certain announcements with this war over the last 2 months. This is their story this morning. The Department of Justice is investigating a series of suspiciously timed trades in the oil market just ahead of major announcements by the president about the war against Iran. This according to sources speaking to ABC News. The DOJ, along with the Commodity Futures Trading Commission, is probing at least 4 of these trades where traders made a total of more than $2.6 billion, betting that oil prices would drop right before they did.
They're talking about a couple of specific trades in this particular investigation. On March 23rd, 15 minutes before President Trump announced that he would delay threatened attacks on Iran's power grid, and on April 7th, hours ahead of a temporary ceasefire announced by President Trump. This has been underpinning some people's skepticism around the headlines, and the reason why, for the most part, you haven't seen the kind of knee-jerk responses that you did initially to some of these headlines. We are getting now some response in terms of the market to the idea of easing tensions, but it has a different flavor because there is this skepticism about who knows what first and who's trading on it, and I don't want to be the sucker left holding the bag.
Right, and you could see some of these massive bets that are placed conveniently 20, 30 minutes before the President of the United States comes out with a pretty significant Truth Social post. It also comes on the heels of the Wall Street Journal yesterday reporting that U.S. diplomats have been warned not to use any confidential information when they go to prediction markets. The White House also had an internal memo about this. So there is a little bit of concern in the White House about what this actually means for them as well.
Something we have in America that is sacred: deep, liquid markets built on trust and transparency. You do not want to be in a situation where people disengage in financial markets because they don't trust what's happening in front of them.
I couldn't agree more. And let's hope that we get to the bottom of this. There is this underlying feeling in oil markets in particular. And I got to say, yes, it's insider trading, the suspicion of it in the United States, but it's also when you have nations like Japan saying we're going to start to trade in the oil market.
Sure, that's different.
It's coming from all different sides. That said, insider trading is absolutely something that really impedes consumer confidence.
People still ask me if I think or have any information about this White House being in the market and selling down crude.
Yeah, they're scary questions that people are asking, and hopefully we get some answers about what's been happening over the last 2 months. Equity futures this morning on the S&P 500 just about positive. Coming up this hour, we'll catch up with Sonders of Charles Schwab, with stocks extending their record run. MQ of PSP Growth on the enthusiasm surrounding big tech, and we'll touch base with Nela Richardson of ADP, breaking down the latest jobs data. We begin this hour with stocks edging higher and crude holding near $100 a barrel. Sonders of Charles Schwab writing oil prices haven't filtered through yet to weaker economic growth because of lower energy intensity, fiscal offsets, lags, and renewed focus back on earnings and AI spend. Lizanne joins us now for more. Lizanne, good morning.
Good morning.
Good to see you. How powerful has this earnings season been?
Powerful, but a bit narrow. So this is now a week-old data, so it's not something I track on a day-to-day basis. But as of about a week ago, 70% of the dollar increase in earnings expectations was driven by only 3 stocks. You see that within the tech space too. So we've all talked ad nauseum about the narrowness within the market at times in the last several years. You are seeing a bit of that in earnings as well. So you are seeing across the board improvement, but within certain sectors like tech and communication services, the earnings growth boost is concentrated in a small handful of names.
I know we sound like a broken record because this always comes up and we always ask the same question. If I'm in the index, is that a feature or a bug? Because in America in the last 10, 15, 20 years, certainly feels like a feature.
If you're in an index, yes. Interestingly, though, there's been a higher growth rate in active ETFs than there has in passive ETFs. So you have seen a bit of a movement. And in fact, more recently, because we had a broadening out in the market that's eased back since the onset of the war, there has been more interest in active management. And then you are not fully at the mercy of what the indexes are doing. And it's also the case that even though there's still some concentration, it's in different names. So Mag 7 is no longer sort of the uber focus of investors. I mean, the best Mag 7 performer this year is ranked 72nd in the S&P 500 this year. So they're not the best performers. They're still high contributors to index gains by virtue of the multiplier of their cap size, but they're not the best performers.
Are rate cuts or even just rates staying where they are enough to unleash this broadening in a more material way?
I think the market is fine if rates stay where they are. First of all, I think that's the appropriate stance on the part of the Fed right now. I think it was the right thing to do to put themselves in a timeout box, and I think it's the right thing to stay there for now. But what I think is interesting when thinking about Fed policy is any rate cuts will likely be driven by the employment side of their dual mandate. Any rate hikes would be driven by the inflation side of their dual mandate. So we really do need to keep that dual mandate in focus because one is a driver of potential cuts, one is a driver of potential hikes. For now, I think there's enough of an equilibrium that the Fed won't do anything.
The reason why I ask is it seems like people are looking for some sort of excuse to rotate away from semiconductors, to rotate away from some of the high-flying tech names that have benefited during the Strait of Hormuz crisis as people look for havens. I just wonder what they need for that confidence, given the fact that earnings really have been concentrated in a number of names. And frankly, there are some real risks that come with higher inflation for some of the other names that people are kind of flirting with.
Well, I think a rotational market is likely to persist. We've been in this recent mode of tech focus again, AI, not just tech, but comm services. But that started with a rotation back into the meme stocks, the heavily shorted stocks, retail favorites, quantum computing. That you've already seen a shift away from those areas back to more traditional tech, with the likes of an Intel being the second best performer, SanDisk, Micron. So to some degree, some of those old school tech names. But I think those rotations are going to continue. The churn and rotation under the surface, I think, tells a fuller story of what's going on in the market versus just what the index level returns are.
You're one of the first notes I've read in a while that didn't mention Iran once and the conflict in the Middle East. Have you just fully moved on?
No, but the intraday and day-to-day correlation, inverse correlation between Brent oil and the S&P has eased a bit. First of all, I think this market does at times look very casino-like. The story you broke on some of those trades, I've been writing about this a lot recently. I wrote a piece a few weeks ago with Kevin about gambling versus investing and how the lines are blurring, and just wrote a piece again, or I just recorded a video again that will be posted today on the same subject, on the prediction markets and further blurring of the lines and the minuscule percentage of accounts that actually make a profit with those bets. But I think it's indicative of the mechanics of the market right now and how much short attention span money is driving the market. And that's the short attention span. It's not my personal attention span. I think the war is extremely important because the quote you read from me, the filter into the economy is still ahead of us, not behind us. But the nature of the market right now is shiny new object. And
but what is going on with some of these trades? Does it degrade U.S. capital markets where potentially people wouldn't want to invest, or is that going too far?
Well, yes. In fact, a poll that was recently done that I cited in this video that is posting today, it was a very wide survey, and I think it was only 4% that felt the prediction markets and betting markets are good for society. So I do think, but there was a recent Harris poll that suggested a lot of younger folks view this as the only key to success. They don't believe in sort of the systems. They don't have trust in the systems, and they're gearing themselves more toward these betting markets to some degree as a get rich quick. But I feel financially behind, and I don't have trust in things like Social Security and traditional retirement structures. So this is the key to bypassing that.
I don't want to take away too much away from something that you haven't published yet, but just some additional thoughts on that if you can. That's a new demographic.
Yes.
Do you see these trends as sustainable?
Well, if you look at the Harris poll that I cited, which is in the report from a few weeks ago, they did a poll based on generations. Now, I'm a baby boomer, and it was only about a 50%, yes, I think betting markets make sense and feel that it's appropriate to participate in them as a way to get to your financial goals. But it was 80% for the youngest adult generation. So, and it was a steady increase in the percentage of folks saying, I don't trust traditional systems. This is the way to make some money.
It's one thing for people to feel this way about Kalshi and predict it. It's another thing for people to feel this about oil futures or names of particular stocks.
Right.
How much do you see prediction markets and the behavior there bleeding into the broad-based markets that people think of as the very liquid and robust U.S. capital markets?
I think that's another place where bleed is a good word, blurring of the lines. So I do think it is starting to filter in. And I think these news stories are getting an increasing amount of attention. And what's also interesting is I cited some data in this video that in terms of the success rate on the prediction markets, on Polymarket, on Kalshi, the highest success rate, which is actually just north of 50%, is in military and defense. Maybe because of the asymmetry that is more clean than the asymmetry in other categories in those prediction markets. But this is an ongoing story. Was it prediction markets on which the bets were placed, or was it in the traditional energy markets?
I believe this story is about the futures market in the energy sector.
Okay, got it. Yeah.
Looking forward to the video being published.
Well, thank you.
Thank you very much for being here. Lisanne Sonders there of Charles Schwab on a shaky market that keeps grinding out all-time highs on the S&P 500.
Yeah, and some of the classic pillars may be changing. I mean, I feel like that's the takeaway for me is how much people's attitudes toward it are changing. And you think about the pandemic era of people sitting in their rooms looking for a quick high, and they thought, well, we can just trade some stocks or we could trade prediction markets. And how much is that informing the whack-a-mole action that we see every day?
They think the game's rigged. And when you see headlines like that...
It is.
It is. There's a worry that the game is rigged.
Right.
And the YOLO generation, to Lisanne's point, you can understand why they feel like that they're not going to get out of society what others before them got out of society. And for the only way for them to get ahead is to take some high-risk bets.
And they've grown up in a period where you haven't seen a huge downturn in the market. We haven't seen a real capital cycle the way that we did in 2008, 2009. So since then, you'll get bailed out. So why not?
And that's a failure of successive administrations, not just in this country, but in other countries too.
Yeah.
We've seen this across the board in the West.
Yeah, you could say that ultimately this is the monetization of the financial system and how that has sort of fed into the perceptions of risk and how that's coming out. But I won't say that right now because I'm just going to get back down off my pedestal and I'll save it for home.
And we've got to get to commercial break in a minute as well. So futures right now in the S&P.
Dinner sounds fun tonight.
Abramo and dinner is going to be fun later, right? Equity futures on the S&P up by 0.1% with an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. As you all were discussing, the Justice Department is investigating a series of suspicious trades in the oil market. ABC News reporting the DOJ is looking into at least 4 instances in which traders made more than $2.6 billion total, betting that oil prices would drop just before they did. Meanwhile, Citi shares are trading lower in the pre-market after the bank's new guidance showed that it would take much more time to catch up to its peers. Citi expects to reach a return on tangible common equity of about 14 to 15% by 2031. Investors had been looking for a more aspirational long-term target of 15% or more. And Boston Fed President Susan Collins agreed with colleagues who dissented over wording in the Fed's post-meeting statement. Collins telling Bloomberg News she would have preferred adjusting that statement away from its easing bias. Collins expects rates to remain on hold, but isn't ruling out hikes. That's your Bloomberg brief. John.
Yahara, thank you. Appreciate the update. Up next, the Morning Calls Plus. Mama Q of PSP Growth on the enthusiasm surrounding big tech. That conversation just around the corner. Live from New York City this morning. Good morning.
The story clearly within tech is semis. The flow of trade and getting all the goods has been surprising. And number two, it's about this rotation within semis. 3 years ago, GPUs. A year ago, memory chips. And now, CPUs. So it's back to the future. And that's the part that's caught people off guard, is the rotation.
Dan Skelly of Morgan Stanley weighing in on the tech trade of the last year or so and the big moves we're seeing in chip stocks more recently. Equity futures on the S&P positive here by 0.1%. The opening bell about an hour and 12 minutes away. That's the price action. Let's get you some morning calls. First up, Wells Fargo raising its price target on Uber, expecting accelerating growth in the second quarter. Your second call from Guggenheim raising its price target on Disney, seeing strength across segments. And finally, JP Morgan raising its price target on ARM to 240 and keeping an overweight rating, citing a clean quarter and relatively inline fiscal 27 outlook. Surprising, because that stock is getting hammered for other reasons this morning. It's down by 9%, I believe, on sales to phones. The lower end of the phone industry, smartphone industry, not doing well, Bramo.
Yeah, so not necessarily the iPhone, but the rest of the universe as people talk about constraining their spending. Really interesting how different some of the stories are depending on the sector. You just see the K-shape in different industries. ARM, a perfect example of that.
ARM down this morning by close to 9%. Let's stick with tech. Momo Q of PSP Growth writing, the AI conversation has shifted from capability to monetization. Markets now want proof of returns, not just bigger models or bigger capex. Momo joins us now for more. Momo, welcome to the program. You say that's what markets want. Give us some examples. Is Meta a good example of that, and the price reaction of Meta recently to earnings? And can you think of others too?
Sure. I think there's a few examples of that. And the bigger picture is that AI is now shifted from promise of good capabilities to show me the money. It's no longer enough to say, here is the promise of what AI can do. Investors need to see real returns in real revenue growth. So one example is actually Alphabet, which is arguably one of the best performing ones of the Max 7. There's a clean story around revenue growth from search, from Gemini, upsides in Waymo, upsides in YouTube. So you're seeing that stock perform very well. Meta, to your examples, is an interesting story. So because the other side of this is investor expectations. It's not enough anymore just to be earnings. You have to be investor expectations. And Meta, for the last few months or quarters, investors have had skepticism around its AI strategy. So there's some of a turnaround story too in terms of Meta. So you think of Alphabet, you think of Meta. I would say Amazon too is starting to have a cohesive story around how AWS fits in with e-commerce, and those are the things that investors are excited about.
One name missing, Microsoft. Where does Microsoft fit in, and where do you think things aren't going right?
I'm probably more bullish on Microsoft than maybe the rest of the market. I think an issue with Microsoft is investor expectations were just so high on Microsoft from the very beginning. They were such a front runner. They were very aggressive with AI from the very beginning. The partnership with OpenAI, they own so much of the stack, from touching developers to touching users. And then they had Copilot a lot earlier than a lot of the other tools in AI. So I think part of the story is investor being, why isn't Microsoft already dominating the AI war? And where is the exponential monetization as opposed to something more incremental? But I believe Microsoft is solid, and the market is probably underappreciating it.
Well, how do you understand whether we're overhyping or the market is overhyping the gains of Anthropic and OpenAI ahead of their initial public offerings potentially later this year? We're working through a lot of investments, whether it's Anthropic now and SpaceX, or of course, Amazon having investments with both Anthropic and OpenAI. Can you get a good gauge on how much is hype and how much people are actually seeing return on investment?
I tend to focus, there's a lot of hype in the market. I tend to focus on what is real enterprise adoption and where are users actually paying money. And I think a lot of the Anthropic success story, even to date, is since the very beginning, they've been hyper-focused on critical business use cases. They didn't chase the consumer market. They've been very focused on building enterprise partnerships, like you saw in the recent partnerships they built with large private equity firms. So their focus from the very beginning in terms of what do people actually want to pay for, I think is really important. That intersection of what's possible and what's valuable is where economic growth is going to happen.
If you haven't invested, Monet, in some of these names while they were private, are the equity gains up, right? I mean, you think about the recent couple of years and companies IPO, and then their shares tend to do nothing or even fall for the next few years. Are we heading into the same type of dynamic with the likes of Anthropic, OpenAI, and SpaceX?
I think the market is going to react in a more nuanced way. The examples you gave, I would also throw in some of the AI infrastructure names, like Cerebras is about to IPO. You can look at some of the companies that are about to announce earnings, like CoreWeave and Nebius. And I think what you're seeing is not just growth at all costs anymore, because what investors expect from these names is big growth, big losses, the investor demand for AI. The demand for AI is proven, is more going nuanced now in terms of shifting to what is GPU efficiency, what are some long-term contracts, what are real. And I think companies that can show that they have long-term recurring repeatable revenues while controlling efficiency around the compute will still be favored in the market.
What has been the reaction in the space in terms of security following what's going on with Mythos?
Security is a big topic, and where this fits into the broader picture is as AI now becomes more mainstream, you have implications, right? These powerful tools, including Mythos, is being put into the hands of the users. These tools are affecting the way we live, we work, we play. So we need other solutions in order to protect our users from the influx of these AI solutions in terms of security. So us here at PSP, we're bullish on the security sector as well. We have two portfolio companies in the space. One is a company called Zafran. They detect in enterprises vulnerabilities from everything from old threats to the newest AI threats, and you rank them, and there's an agentic capability to mitigate them. We have another company called Cinder in the space. What they do is they make sure all the content is trusted and safe and moderated before it gets proliferated to the users. So I think security is a big piece of the puzzle as AI moves from experimentation to being more mainstream.
It's going to be a much, much bigger piece of the puzzle, that's for sure. Monet, appreciate your time. Thanks for jumping on for us. Monet Q there of PSP Growth on the difficulties over Meta, the success of Alphabet, and where does Microsoft fit in? That's a big question right now.
Yeah, especially because they didn't see the same kind of cloud growth that some of the other players did, AWS in particular, and Google. Honestly, Microsoft seems to have, it sort of goes in a cycle, right? So the ones that get beaten up, are they going to pull a Google? Are they going to pull an Alphabet? I don't know.
What a turnaround from Alphabet.
I know, right? I really think we can't talk about that enough.
Crazy turnaround. Up next, jobless claims in America. Nela Richardson of ADP reacts from New York City. You're watching Bloomberg TV. The open about 60 minutes away. Equity futures into that positive by 1/10% on the S&P 500. Seconds away from jobless claims. The last big data point in the labour market we get ahead of payrolls tomorrow morning. Claims are coming in super low. Multi-decade lows. Let's see if we get a repeat act in just a moment. Into that data. In the bond market, 2s, 10s, 30s, yields shaping up as follows. Yields on a 2-year dropping by 2 to 3 basis points, down 2 on 10s as well, 433. Let's get to those claims. Still low. Mike McKee has more. Hey, Mike.
Still low, John. Good morning from San Francisco. Claims come in at 200,000 even, up from a revised 190,000. So still low, but we moved away from the record low level. The continuing claims number, though, drops 1,766,000 from 1,776,000. So we are seeing some improvement in the longer-term claims picture, but it all basically tells you that the labor market is stable, sort of the same message we got out of the JOLTS data the other day, and of course tomorrow we'll get the payrolls data. Also getting productivity at this point, and unit-level productivity for the month, for the first quarter rather, is non-farm productivity is up at an 0.8 pace. That's down from 1.6% in the fourth quarter. Of course, GDP was higher. Unit labor costs the fall, though, from 4.6% to 2.3%. So productivity having some benefits there. But the issue, of course, and I feel being in San Francisco, I should talk tech. We're not seeing a lot of productivity yet in the numbers from AI. And most of the folks on the Fed don't think we're going to see it for a little while. Even if Kevin Warsh thinks that's justification for cutting rates, that's not what we're hearing from members of the Open Market Committee right now.
Mike McKee on tour. This will be a good one, Mike. Looking forward to the conversation with Mary Daly a little bit later this morning. The San Francisco Fed president and Mike McKee catching up with each other around noon Eastern time. So that's in the morning in San Francisco. Mike, just give us a flavour of what you and Mary are going to be discussing, particularly given the additional pushback we've seen to the easing bias earlier on this morning.
Yeah, Susan Collins from the Boston Fed said she would have joined if she were a voter this year, those who dissented. So we definitely want to find out what Mary Daly is thinking. You had an analyst on earlier this week who said Daly's one of the most important voices because she's been one of the biggest doves. So if she's willing to hold off, then it makes it even harder for Kevin Warsh. We talked with John Williams earlier this week, and the New York Fed president also said that what they're doing now, while it's not hard forward guidance, it is forward guidance in the sense that it's telling people what they think the most likely path for monetary policy is given the economy. And all these people are suggesting that maybe Kevin Warsh's idea of getting rid of forward guidance isn't going to take hold. That's what Claudia Sahm is writing in to tell us this morning. She thinks Susan Collins made that point, that Warsh is not on board with what the rest of the committee are thinking at this point.
Mike McKee, thank you, sir. Looking forward to that conversation with the San Francisco Fed President, Mary Daly, later on today at about 12:30 Eastern Time. Think about what we're arguing over here. Just a couple of words in the statement. Something like additional easing, additional adjustments may be required. Don't even use the word easing. Additional adjustments may be required. That's what the argument of the Federal Reserve is right now.
Well, and it actually has a pretty significant economic implication, which is this still a Fed that has room to cut? Or are we at neutral and potentially even overly easy based on the strength that we're seeing in the underlying economy? My question is the initial jobless claims metric broken? Are we actually gleaning anything from this? Or is this really telling us just how good things are, that there really aren't that many people who are filing for jobless claims?
So two questions. I'll start with the second one. Don't know. On the first question, I certainly think we're redefining what dovishness is at the Federal Reserve right now. At the start of this year, it was cutting interest rates. And now 3, 4, 5 months in, it's just not hiking and holding on to the easing bias. And that's the fight now for the doves.
And over to you, Kevin Warsh. And here is the key issue for markets. How much is the market pricing in a really dovish Kevin Warsh that's going to come in on a mission to cut rates? And how much is this market appreciating that this person might be constrained by a committee and, frankly, by economic data that is not pointing toward any kind of easing?
Can you rely on claims? Someone far more better positioned than I am to answer that question. Nela Richardson of ADP joins us now for more. Nela, good morning.
Good morning.
Before we get into claims, I want to talk about ADP. Encouraging signs here. Are we actually starting to see a pickup in this labour market?
You know, last year there was a trend, and it was clear. It was all downward in terms of monthly growth, and that was a trend that has been going on for 3 years. This year, we're actually starting to see some green shoots of dynamism. The stagnant low fire market is starting to break and thaw a little bit. The issue is that there's no clear trend yet. So yes, there's some green shoots. We're watching for a trend to develop.
Can I say we've broken the old trend? Can I go that far?
I think so. But we're trending at a lower rate, but we're not trending downward. So that's a very important distinction in 2026 that we didn't see in 2025.
Let's take that dynamism. Are we seeing wages pick up as we get that churn pick up in the labour market?
Okay, so here's the rub. It's a solid labor market. We saw 109,000 private sector jobs in April created. That is the biggest number we've tracked in 15 months since January 2025. Here's the rub. The jobs that are being put into this economy are part-time and low wage and mostly tied to healthcare. And so the jobs that we're replacing are not as high paying and don't work as many hours as the jobs that have been lost. And so I cheer a lot of things. I cheer that low initial jobless claims, and I cheer the continuing claims number going down. That's so critical. But we still have to be clear-eyed, and as my oldest son would say, not have any cap I don't know if I used that right, about the reality of this jobs market, where the job creation is just not as strong as we'd like it, given all the AI productivity investment.
I think it's no cap. I don't
No
think that you
cap.
would say don't have any cap. But
See,
that's okay.
I've embarrassed him
it's
in
fine.
like the
No
last
worries.
30
it's
seconds.
Fine. But to build on what you're talking about, there is a feeling that there is some strength in the numbers, but it doesn't seem like it necessarily is something that would be at risk of a wage price spiral. Will the idea of a robust labor market constrain the Fed's ability to cut rates and potentially push them to hike? Or is this something independent of that is secular to the healthcare industry and to jobs that previously were held by, say, a population of immigrants?
Yeah. A wage price spiral was never a threat. In all the inflation scenario, when economists were really laser focused on this occurrence happening, this theoretical construct of a wage price spiral, it never materialized and is even less of a factor now. Yes, there is wage growth stability. Yes, it's at a level higher than what we saw before the pandemic. And yes, there are some clear labor shortages, a lot of them tied to immigration or aging demographics. Still not enough. Still not enough to lead workers to top out over inflation. And so for me, that's a problem. If we have some inflationary pressure and pretty stable wage growth, but not enough to keep up with energy prices or higher food prices, then that's a problem for workers.
Which is the reason why you're seeing it on the margins and why people keep talking about the K-shaped getting wider and wider. The jobless indicator, I'm just wondering, initial jobless claims, is it relevant anymore? Has it just essentially been rendered an arbitrary 200,000 plus or minus some?
It's my favorite broken record. Repeat, repeat, repeat. I don't want to see that number go up.
Okay, but is it an indication of anything, or is this just essentially someone entering a number that's just been automatically generated?
You know, I can't answer that with any confirmation. It is a signal. Is it a flat signal right now? Yes. Is it because the economy is doing pretty good? I hope so, but I don't know for certain. So it's a question worth asking. And we should ask, as an economics profession, as people who track that data, is it giving us the same signal now as it has in the past? A lot of things are changing. We see that the labor participation rate is changing. Labor supply is changing. We have all these investments in technology changing. Maybe that number is fine. It's just not giving us the signal it has historically.
We've seen some layoffs, though, at big tech companies, and a lot of them are saying this is because of artificial intelligence. You're tracking mom and pop shops.
Yeah.
Are they insulated from that?
They're not insulated from macro trends, but yeah, they're not going to be the early adopters of frontier technology. And mom and pops, you know, the industry organization is geared towards construction jobs. It's geared towards like home healthcare aides and service sector jobs. So service meaning in-person services rather than in front of a computer service. And so, yes, there is some sense that they have a moat, a small firm moat around them when it comes to AI, because the business is different and they're not, again, going to be the early adopters of technology.
Do you feel like small businesses are having somewhat of a renaissance?
Definitely. And this is because of agility. When everything's changing in the labor market, small firms are agile. They can hire that part-time worker. They can hire that person that was retired but has skills and wants to stay attached to the labor market. They can free float in a way that larger firms are more constrained to doing. And that's what we're seeing in the data. They're actually using their smallness as an advancement. I'll go a step further here because it's Small Business Week. Small firms are the future. If AI delivers on its promise, which is scale, it's not just efficiency. It's being able to do more, produce more, create more, and innovate more. You no longer have to be a big firm to do big things. You can be a small firm and scale. So I think small firms will grow their big footprint. They're the engine of growth already. I think they only become more important over time.
I'm going to run with the optimism. I'm going to run with it. Nela, appreciate it. Thank you. Nela Richardson there of ADP. A better conversation about the American labor market.
Yeah, and we're seeing it in the numbers. I mean, having a dead signal at 200,000 in terms of the initial jobless claims is wonderful. If it really is giving us a signal, one viewer, and I think this is really interesting, points out that the jobless claims could be at this low level because of the higher number of retirees on a weekly basis. Is also skewing the quits rate. I'm going to have to wrap my head around exactly how that is featuring into this. But we do see a big demographic shift. A lot of people are leaving the workforce because they can on all of their stocks that they have gained so much on.
No envy there whatsoever.
And their low mortgages that they got and it's really low prices for their homes. Yeah. They can retire.
Boom is doing all right, right?
I wonder who that is.
Yeah. Brown's not a boomer.
No, but low mortgage rate.
Sure. I mean, often brags about that.
Yeah.
Come
Why
on,
not?
it's the one thing I can brag about.
I'd be bragging
Let me.
too.
True, I'd be bragging too.
I'd be
there you
bragging
go.
as well.
Bragging
the median
rights.
estimate for payrolls tomorrow, 65k in our survey. The high is 140, the low is -15. The jobs market centre stage tomorrow morning, 8:30 Eastern Time. Let's get you an update on news worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Recapping the data we just got, jobless claims coming in at 200,000 last week. That's lower than estimates for 205,000, but up from last week's historic low. Continuing claims falling, coming in at 1.76 million, also below consensus. Meanwhile, we are seeing shares of Shake Shack plunging more than 20% in the pre-market after the burger chain missed first quarter expectations. The company pointing to higher beef costs and a stretch of bad weather weighing on results. Even so, Shake Shack isn't raising prices, thank you, and is sticking with its full-year outlook. And in sports, the Knicks taking a 2-0 lead over the Sixers in the second round of the NBA playoffs. 3 Knicks players recording 20-plus points, Philly missing its star player, Joel Embiid, due to injury. Game 3 tips off in Philadelphia tomorrow night. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate the update. Up next on the programme, Cameron Dawson of NewEdge Wealth, with stocks gearing up for another record day. Plus, Danny's back with your morning movers. Another check on Citi, falling, down about 1.6%. We'll get to the why in just a moment.
Mag 7 is no longer sort of the uber focus of investors. I mean, the best Mag 7 performer this year is ranked 72nd in the S&P 500 this year. We had a broadening out in the market. I think those rotations are going to continue. The churn and rotation under the surface, I think, tells a fuller story of what's going on in the market.
That was the brilliant Sonders of Charles Schwab joining the programme a little bit earlier on this hour, setting the stage for the opening bout. That opening bout is about 44 minutes away, with equity futures elevated and up by 0.2% on the S&P. Similar move on the Nasdaq. All-time highs coming into this morning, adding some weight to that rally in the commodity market, helping out crude lower, now down by 5% on WTI and just about holding on to 90. Brent crude down by a similar amount and just about holding on to 96, well south of triple digits.
People want to move on from the story of the Middle East and focus on earnings, which have been coming in robustly, both in the tech side as well as on the consumer side. We're talking about McDonald's beating expectations on earnings. We're talking about DoorDash beating expectations. We're talking about all of these consumer brands, even Uber. People are spending on discretionary items despite the fears of inflation.
Consumers are still resilient, even with $4.50 a gallon on the national average and going up. It was up today. What I find interesting is it feels like there's a lot of calm right now between Washington and Tehran as we are waiting for them to respond to this one-pager. And you have the Iranian president actually meeting with the Ayatollah for 2.5 hours, according to their press TV. So there is some movement in terms of conversations happening in Iran, and I would think we would get that announcement coming today.
Let's see if we can make some progress here with that move in crude. Push it into the bond market. Yields down across the curve. 2's down by 3 basis points, call it 4. 10's down by 3. 432 on 10s this morning. That's how the stage is set cross-asset. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Citi in focus this morning with their investor day. There was a lot of high hopes for this company, given it just reported earnings that saw returns at a 5-year high. Instead, they revealed their return on tangible common equity targets, and it missed expectations. They see somewhere between 14 and 15%. Just to put it in perspective, JP Morgan, when they reported, it was about 20% for 2025. Analysts at UBS say that the market was hoping for 15% and higher. Instead, that seems at the top end of their estimates. They did, though, authorize a $30 billion stock buyback in a multi-year program. Elsewhere in earnings, Lisa, you mentioned this really strong showing from McDonald's. Their global same-store sales rose in the quarter year over year. Last quarter was a decline, so they were able to fight that. They said it was their value-driven menu, their Big Arch Burger, all of those popular with consumers, up 2.7%. But the consumer earnings haven't been bright everywhere. Check out what's happening with Whirlpool, down a whopping 21.33%. They cut their estimates for where they're going to this year in half. JP Morgan says that raw material costs are a lot higher from them, but the company's statement was really something to behold. They said that this industry is in a recession level kind of environment. They say it's due to the war in Iran that consumer sentiment took a hard turn in February, in March. It's an issue for them, again, saying that things look like a recession to them. John?
Danny, thank you. That is a different story. That's notable. Feels like an outlier right now, but it's notable.
It also is tied to the housing cycle and how much people are actually moving and all of the goods that they did during the pandemic. Remember, we're in these sort of strange cycles that have also been foisted upon us, from a pandemic no travel to pandemic travel, etc.
People stuck with 3% mortgages and not moving houses.
Yeah, but initially they were buying dishwashers, and then
shouldn't they be like renovating and
they already
having
did that.
refurbishments?
That was part of the 2003.
Need to push them out of the
2023.
houses.
Yeah.
Get them moving again. Give up those
Were you trying to make me go? Really?
I'm trying to make you move. Come on. Equity futures right now, the S&P positive by 0.2%. Your next 24 hours looks like this. This is what the trading diary is given to us. At 11:15 Eastern time, we'll hear from the president. He's meeting with the president of Brazil. Some tension between those two countries recently, so look out for some of that. I'd also say the more important deadline, of course, is whether we hear from the Iranians and what they say to Pakistani mediators in the next 24 hours. Also today, lots of Fed speak, Hammock Daily, Kashkari and Williams Daily as well, catching up with Mike McKee, so look out for that too. After the closing bout, earnings from CoreWeave and Cloudflare on Friday, tomorrow morning. The main event, of course, is not you, Mitch, it's the payrolls report. Look out for the payrolls report. You, Mitch, consumer confidence right now as an indicator, largely useless at the moment for a lot of people, at least from a financial market perspective.
If jobless claims are raising questions, University of Michigan is essentially all but forgotten. So, yes, a lot of people are using this as a political poll more than anything else.
Cameron Dawson of NewEdge Wealth writing the following: respect the trend, but don't ignore the risks. Let's talk about the risks right now. Cameron joins us for more. Cameron, good morning.
Good morning.
What are the dominant risks for you?
Well, I think the fact that this market is very much in an uptrend, which we think should be respected, but this uptrend is being driven by a narrow cohort of names, which, of course, we are in an earnings boom, but that earnings boom is narrow as well. So even though we saw a new high yesterday, that big, bold, beautiful new high, only 55% of names are above their 50-day moving average, and you actually have over 30% of the names in the S&P 500 that are below their March 30 lows. So it's not to say that this is an uptrend that you should fight. It's just to say that you should have risk management in mind, because a lot of this upside is being driven by highly parabolic moves in a small cohort of names.
What does risk management mean?
Yeah. Risk management means likely taking some money off the table, trending some winners. If you look at the semiconductor index, it's now trading at 57% above its 200-day moving average. We haven't been that overbought, that extended above its 200 days since going back to the early 2000s. Now, of course, March of 2000, we hit 98% above its 200-day moving average, so things could get even sillier. But as the saying goes, nobody got poor by taking gains.
At this point, people are looking for the next catalyst. It does feel like we've all been having a case of ADHD with all of the headlines, considering the fact that they seem to be whipsawing the market, the perception, et cetera. What's the big next catalyst? Is it jobs? Is it the election cycle? Is it the hantavirus?
Oh, well, hopefully not the hantavirus. I'd say the election cycle is really interesting because usually midterm election years carry the highest volatility and the lowest returns. So if you look at the bullish expectations for total S&P 500 returns by the time we get to the end of the year, that would be very, very different than what we would normally see in a midterm election. I think the thing to watch with jobs is if we get another hot jobs print, are we talking about more upside to yields? We saw the 2-year yield get close to 4%, the 10-year yield get close to 4.5%. And does that start to become a challenge for a market that is trading at ever-increasing high valuations, as well as put downward pressure on some of those cyclical areas of the market like housing, which is likely one of the reasons why Whirlpool is so weak today?
You talk about yellow flags. What are the yellow flags you're watching?
I would say something like financials trading below their 200-day moving average. That's certainly something that we don't want to see. Financials at a new relative low. We want them participating in this rally as a sign of good cyclicality. I'd also flag equal weight discretionary versus staples. That has been pricing in some of this consumer pressure that we were seeing from higher oil prices. The important thing will be if we do see oil prices continue to moderate, do we see that ratio start to rebound, which would be a very important cyclical indicator for this market.
There was so much excitement about this cyclical bounce at the start of the year. Do you think we've upended that or just delayed it?
We never saw much evidence that it was coming. Yes, maybe if you looked at the PMIs, you could see some signs of an acceleration. But the reality is that PMIs, just like things like UMISH, have been very, very poor indicators this cycle. You saw some bounce in things like transport, some cyclical areas. But in many ways, that was a very last shall be first kind of trade. Look at the first 2 months of this year. The two leading sectors were energy and consumer staples. They weren't leading because they were pricing in some kind of expectation of a war or some kind of turn down in the consumer. They were leading because they were the worst names over the last 3 years. So it really was just a rotation from the worst into the best. And I think what's interesting is, do we start to see a bid for that broadening out come back again if this war is truly going to moderate? And if that doesn't happen, that certainly could be that we continue to have this very narrow leadership.
How strange would it be if we saw a rotation into energy after the Strait of Hormuz issue was addressed?
Well, I mean, these stocks have not performed well through...
They've done nothing through the war at all.
Yeah, look, I think that maybe you could make an argument that there is some kind of infrastructure build-out that could benefit some of these names, that you could argue that it could be supportive of earnings. But I think that energy still has a right and a place in a portfolio as a geopolitical hedge, simply because there were a couple days where energy was the only thing that was up, which is nice as a buffer in portfolios.
The very start of March, and then it faded really quickly. It's so strange, the performance of that sector. I know they had a really powerful start to the year. I get that. But you would think that certain parts of that particular energy industry would have really taken off, and it just wasn't the case.
Yeah, especially given that their earnings were significantly higher than expected as a result of higher energy prices. At the same time, not necessarily investing in pumping more, and they did have infrastructure damage. So people kept coming on and saying, well, it was the rally before, it was the infrastructure costs. Let's see if now we start to see a shift.
Cameron Dawson, it's good to see you.
Good to see you.
Thanks for being here. Cameron Dawson there of NewEdge Wealth. Coming up tomorrow, we'll catch up with Chris Verona, Strategist, Priya Misra of JP Morgan, Michael Collins of PGIM, and Francis Donald of RBC. The jobs report tomorrow morning, 8:30 Eastern Time. Full coverage right here on Bloomberg TV. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.